Before we begin our session, I request the members to raise up for the ICAI motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैत 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 एतद्द्वैत.
I request Revati S. Raghunathan, Chairperson of SIRC of ICAI, to begin the celebration by delivering the welcome address.
A very hearty good morning to everyone present today. I am deeply honored to actually welcome our Central Council member CA Rajendra Kumar sir, who has immediately accepted to come here today and deliver the special address, and of course to all the speakers of the day, and particularly now to CA Sathyabama, who is a partner in ASA, one of the top firms, who immediately agreed to come and give us a different interpretation on the interplay between the accounting and auditing standards. And of course to our own Chinnasamy Ganesan sir, who is going to lead the panel discussion. Today we are celebrating Accounting Standards Day. It seems rather a little quirky to celebrate Accounting Standards Day, but I think that accounting standards is the backbone of our profession, and all of us should understand that accounting standards actually enables us to follow consistency in presentation, which is going to enable all the stakeholders to understand whatever are the financial statements that we are going to go through. See, not enough that we call ourselves as the partners in nation building, and that we enabled the GST collections, and we are doing the income tax collections, broadening the tax base, contributing to MSMEs. We are doing so much, and our contribution is actually widely recognized all over. But this accounting standards is slightly downplayed by us small and medium practitioners, because we think that it's only the forte of the bigger firms, bigger corporates, and the presentation for the international purposes. But no, even the smallest balance sheet should have the same presentation as the bigger ones, because whatever it is, the interpretations are going to, and the results are finally going to be assessed by the stakeholders in the same manner for whatever the purpose is. So that is why the Central Council has actually decided to celebrate the Accounting Standards Day, and we have our CCM here. And it's really heartening to see that many people have actually understood the importance of this and come, and we have some really very good faculties, a very good panel discussion which is going to happen. So I'll leave the rest of it to our CCM. I just wanted to give two small updates. One is we are having our regional Southern India Regional Conference on 22nd and 23rd of August. It is here in Nehru Stadium. Please do join us and support us in big numbers. We are showcasing Chennai in a very big way. I would say after I am actually trying to reach the benchmark set by our CCM, who's sitting here. His regional conference, when he was the chairman, I think set a very, very big benchmark. Let me see with everyone's support, I will be able to reach the same benchmark, and of course with his advice and support. And two is the CABF contributions. I think you all will know what the CABF is, Chartered Accountant Benevolent Fund, by the CAs, for the CAs. Any chartered accountant who is in need due to various reasons, or the family is in need because of the loss of a earning professional, the institute supports them in a very big way once they reach out. And reach out by the members and their families for the CABF help is increasing, and we need to augment the funds, and that can be done only by contributions from all of us. So if you are wondering how exactly, normally when I contribute money to something, I always want to know what is the end use. We are very used to this end use certification which we give for everyone. So whether we get the certificate or not, always there's this tag running in our minds, what exactly is this fund being used for. You're all welcome, to actually see who are the beneficiaries. We are giving a list of the beneficiaries. Beneficiaries are there who will be supported by a lump sum from the institute, as well as a monthly amount up to the family, the time when the family is able to stand up back on its feet. We support them for 10 years, and all this can be done only with the help of members. We do not have a robust social security system, and the institute takes care of its members in this manner. So please do actually support, and whatever is possible by you, please do give us as much support as possible. And you'll all be aware that the Vice President is from South, and we have actually promised him a big sum of money as contribution from South, from Tamil Nadu, towards the CABF, and that can happen only if each and every single one of you is going to contribute. Every penny will make a difference. Please do not hesitate. We will be reaching out to you again and again for this. Please do contribute and help our own professional fraternity. Thank you once again to all the faculties. CA Lakshmi Narayanan is also here, who have accepted for today's function. I hand over the proceedings now to the MC. Thank you very much.
Thank you, ma'am. I now invite CA Rajendra Kumar P, Central Council Member of ICAI, to deliver the special address.
Very esteemed Chairperson of the SIRC, CA Revati Raghunathan, the first speaker of this technical session, CA Sathyabama, my very good friend and a name in accounting standard today, Chinnasamy Ganesan sir, the other faculty, CA Lakshminarayanan sir, whom I also know very well, very esteemed members who have come here for this accounting standard day, which is being observed by the ICAI for this program organized by the institute. I sincerely thank Revati madam for organizing this, and also ensuring that a good list of faculties are available for the members to take benefit. I must admit that I don't know anything about accounting standard.
You're the GST man.
I don't know whether I know that also now. In fact, very, very frank, I have been a member of the Accounting Standards Board of ICAI as a member, but I hardly remember attending any meeting. And then why you are there, people will ask. Sometimes you need quorum. There are members who are obedient members, and they'll come, they'll put the quorum, and they'll say, you continue, sir, I'm with you, you all support, please go ahead, that's all. That much only I know. Because at the end of the day, you cannot do everything as a council member. You cannot poke into your nose on every affair that is happening. If someone is expert in that, if Chinnasamy Ganesan sir knows, if Lakshmi sir knows, and Sathyabama madam knows, leave it to them. So when this day was supposed to be celebrated and the council decided, I said, you know very well, please go ahead, you have my support, that's all. That is the only thing. And last I read about accounting standard, if I can remember, read, was for the CA exam, final examinations. I qualified in 95. So it was some AS 13 or something, investments. 13 investment, அது ஞாபகம் இருக்குப்பா எனக்கு. 13 investment, அப்போ தான் வந்து ஒரு draft standard is coming. 13 has not become mandatory. Only 12 standards were there. So in that, only one standard I could remember proper. That was AS2, which is on inventory. That's the only standard I could remember, I could write also in the exam. Otherwise, even for CA exam also, every point will just walk through that. But then when it came to disciplinary committee, I was on the bench of DC for 4 years. Now I am presiding officer, 3rd year in succession of the Board of Discipline. Fortunately, the accounting standards type of violations come in the 2nd schedule. And these matters generally come through FRRB of the ICAI. I have been a strong dissent giver when it comes to matters being referred from FRRB to disciplinary committee of ICAI, because it's a too technical. Chinnasamy Ganesan sir will know, all those who are experts in standards or who are students in standards will know. Standards are too technical in nature. I mean, you put me in the sitting seat of a judge and you decide, and there is no complainant also, there is no one to argue as to what is the complaint, there is no point. So I always maintain that don't bring such violations through FRRB. Have a proper forum. And at the end of the day, whether the following or not following of accounting standard has resulted in a serious misstatement of the financial statement has to be seen. There are two things. One is misconduct, other is gross misconduct. These are two different things. What is gross misconduct? What is misconduct? This is how we need to judge. If the accounting standard has not following or following wrongly has resulted in a serious misstatement of financial statement which has directly or indirectly impacted the financial affairs of an individual or of the company, then it is gross violation. Otherwise it is violation. So a violation can be set right. Gross violation because the damage is already done. And as rightly said by chairperson, this is a fulcrum, foundation. Everyone need to know. I also need to know. But then I have chosen not to do anything on the financial statements, nothing to do with any signing of any balance sheets, etc. The last I remember I could have signed somewhere in 19 or 2000, that's all. I never signed any financial statement because necessity was never there. So thanks to the most serious audience who are here. I never expected that the Brahmaya hall will be full, because we know which program, who will come, who will not come, because today people have become choosy. All of you have chosen to hear experts like what Revati madam has lined up today. So thank you for your support. And she was talking about the regional conference on the 22nd and 23rd of August. I must tell you, madam, after 2008, I have been eagerly waiting to attend a regional conference in Chennai. Now only the opportunity has come. And it is a wonderful venue. Only thing is you need to manage the logistics very well. In 2008 when we did, it was under most severest of rains Chennai has ever witnessed. And because social media was not there, we could continue the conference. Otherwise the conference would have stopped. In WhatsApp itself they would have stopped, everyone would have stopped it. So best wishes to you. You always have my support, our support. The council support is there with you always. Do a good conference and have a large audience. That is my sincere request to you. I always look for that how many people attended. It is not the question of the session, speakers and so on. The question of networking, meeting your friends, meeting your colleagues. Maybe you would have met someone before 10 years, before 20 years before you'll meet them in the conference. These are opportunities for you to meet, greet, have fun and also do some learning. I look at the conferences like that only. In fact, though in 2008, the opening speaker was Jaggi Vasudev. No one knew him at that point of time, or rather he was less known at that point of time. So best wishes to you, and sincere thanks to our very esteemed faculties who are seated here, who have come here for sharing their knowledge, and others also are going to come, like CHANDRAMOHAN sir from TAFE, who is also going to be here. My friend, photographer Ramaswami, I won't call him chartered accountant. Photographer Ramaswami, you must know, Ramaswami is one of the finest of the photographers. I mean, if you are following him on Facebook, or not, if you are not following, follow him. Look at the photographs that he has taken. Mind-boggling. There are 3 people in Chennai who are, I rate them as the best. One among them is Ramaswamy, Ramana Kumar, and our N.R. Govindarajan. 3 amazing photographers in the country. So good that Ramaswamy sir is going to be here and speaking on accounting standards also, and of course Shankar Raman sir also. So sincere thanks to them. Please convey my thanks to them also, and my best wishes to all of you. We are always available 24/7. As the convener of members and students directorate, initially I would request you that please pay your membership fee at the earliest. We have simplified a lot of processes. Wherever there is any hiccup, please bring it to my notice. My team is available 365 days, 24/7. The entire directorate is available for any issue that is, sometimes there may be hiccups, please let us know. Nevertheless, please see that you pay your fee at the earliest, latest by 30th September 2025. That much I can tell you. Thank you very much.
Thank you, sir. As a token of our gratitude and appreciation, I request C. Rajendra Kumar sir to kindly present a memento to C. Sathyabama R.
Let us all greet him. His daughter has been engaged just 2 days before.
We would also like to honor C. Lakshminarayanan S. by Rajendra Kumar sir. Thank you, sir. So before we begin, I would like to have a short introduction of Sathyabama Ma'am R. Sathyabama Ma'am is a chartered accountant and a certified information systems auditor with over 2 decades of experience in internal audit, information systems audit and consulting, process improvement and design and testing of control under SOS Act 2002. She is also a certified SAP professional, ISO 27001 implementer and diploma in IFRS issued by Association of Chartered Certified Accountants ACCA UK. Her experience spans across industry verticals and computing platforms, especially ERPs, and has dealt with medium and large organizations and multinational companies. On behalf of SIRC of ICAI, ma'am, I thank you for accepting our invite, and I hope to start the session.
Sorry, friends, before I hand it over to Sathyabama, I just forgot to inform about two things. One is during the conference, we are also having a parallel session of sports. We are actually implementing the rolling trophy in SIRC. So from July, we will have all the prelims, quarterfinals, semi-finals, etc. We are having cricket, badminton, shuttle, pickleball, chess, and carom, and athletics also in case. And table tennis. So request everyone to please participate, showcase your skills. This is also being done under the Work-Life Balance Committee. We want youngsters to come and help us in organizing the sports events also. Join us in organizing the events. The finals will be held at the venue a day before or during the day of the conference also in the morning. So please do come. We have to prove that chartered accountants always work, but all work and no play will not make a dull chartered accountant. So please do join us in all the sports events. And the next thing is tomorrow we are celebrating World Laughter Day. Again, this is to ensure that we all de-stress, and we already have our Central Council member showing us how to laugh. So let us laugh, enjoy. Tomorrow morning, one session is on how to lighten up and laugh, and the second session is a play, a drama by a theatre group, Theatre Marina, which is again founded by a chartered accountant, and there are 2 chartered accountants who are acting in the play also. It's followed by lunch. There is no CPE for this program, and there is no fees. And no fees also, but you have to register mandatorily because we need the numbers for organizing lunch. We don't want anyone to go back hungry. So the play is at 11, the session starts at 10. Please do join, go back home and register. Let us showcase our, and it is open to family members also. So you can bring your family. Let's have fun tomorrow. Yeah, thank you. Over to Sathyabama, sorry.
Good morning, everyone. First of all, thank you for the opportunity to talk at this prestigious occasion. I think most of you would have noticed during the introduction that I'm not been too much into accounts, though I have a diploma in accounting, IFRS. So my entire career actually started largely around accounts rather, so in processes, controls and all that. So it was by accident that my mentor actually got me into statutory audit, a period that I really enjoyed because it was a very, very big learning experience, very challenging client, and one where we also had to do the Indian accounting standards at that time, and then transition to, at that time it was, they had both IFRS and the Indian accounting standards, and they've also transitioned into IND AS. In fact, they were one of the early adopters. So a huge learning experience. So though I may not consider myself an expert, especially in presence of such stalwarts here, I thought I can probably share some experiences and some, 2 pennies of my whatever I can contribute here on the accounting standards. And thank you, Revati, for actually thinking about me to speak at this prestigious occasion. Interplay of accounting standards and auditing standards was the topic that she gave. It totally floored me because I wasn't really sure what was the intent or how do we, I mean, it's very obvious, that accounting standards and auditing standards sort of go hand in hand. So what is it that we can do to engage the audience or tell something differently? So I don't know if I'll be able to say something differently or you'll go back with any insightful knowledge, but at least it would be a the basic minimum that I'm trying to do here is give a reinforcement of what we all already know. So that should be the basic starting point. So with that disclaimer, if you can say, I thought I can start off. Before that, because it is also the Accounting Standards Day, I thought a little brief history session can also help us before we get started. I was just curious about when we actually started on the accounting standards. When I was doing my CA, at that time the standards were not mandatory, and then it's become mandatory, and the standards keep evolving, as and when the business requirements, and then also alignment with global standards has happened. So as you all know, financial accounting and reporting are basically crucial because we need to communicate the company's performance to a lot of stakeholders, including all the bankers, creditors, regulators, and all that. So the need for accounting standards actually comes in because we need consistency and comparability. That's the main thing. So there was a lot of judgmental factors. If you see, auditing is all about judgment, and a lot of auditing standards also talks about judgment aspects that we have to exercise at various levels. So comparability, reliability are two, and consistency. So because if you don't have consistency, comparability becomes very difficult, and that's where the standards started becoming mandatory, because we realized it is necessary to have comparability of the treatment. And of course, trying to bring in best practices so that the quality of accounting itself goes up. So these are the basic objectives. I happen to go through something here, and if you see, Kautilya's Arthashastra itself has concepts, rules, and regulations pertaining to business accounting, auditing, and risk management. So there was a separate session on this, which was interesting reading. So any of you interested in history, and particularly the Indian history, can definitely go through that. So I'm going to skip all of this. So the basic thing is, Accounting Standard Board was constituted in 1977. So that was the first time when we actually thought about having a proper common standards to be established and all that. So I said initially it was all not mandatory, and then it started becoming mandatory. So this is the journey we had. So we initially had in 1979 a preface to the Statement of Accounting Standards, and AS1 was issued. And 87, some of the standards started becoming mandatory. And then of course 1991 was where it became mandatory for a whole lot of corporate entities. So all the basic standards, if you see, on revenue recognition, and then on FA, and then foreign exchange, and all of that. And then 1999 was where Companies Act actually came in and said that is where we got this chapa from the government through the Companies Act about the accounting standards. And ever since then, there have been our standards have been issued under various government, that is Companies Act regulations and rules, the modes through which the accounting standards is actually published in the country. So this is how the accounting standards are normally followed, or drafted and circulated. So the process which is followed is this. The primary board is of course the Accounting Standard Board, and the Accounting Standard Board, this basically defines the preliminary draft. So once a need is felt that an accounting standard is required, preliminary draft is done, and then this is then exposed to public for comments across industry associations, practicing accountants, and all that. And then finally the draft standard is then taken for consideration, and this is given then to the NACAS. And then the NACAS then gives it to the Government of India, and then finally it is issued through a notification. Okay, so this is the process that it follows. So typically most of the standards take at least a year or two minimum, and some of the standards have taken a longer time. For example, insurance accounting standards has taken a much longer time, because it's remained with the IRDA for approval and all that. So now if you see, 2016 was a landmark year, because that is when your IND AS came in. The primary purpose of IND AS was also to align ourselves with the global accounting standards. The need was felt largely because of the overall globalization in India, and Indian companies becoming a good substantial player in all the global arena. Okay, so if you see the accounting standards, they started with you had the companies accounting standard rules, which were issued in 2021. First was issued somewhere in 18, and then subsequently a lot of changes have been made. So these are basically applicable to companies where the equity and debt securities are not listed and not in process of getting listed, and then unlisted companies having a net worth of less than 250 crores, and a company who is not a subsidiary, associate or JV of a company to whom IND AS is applicable. So we basically have two streams of accounting standards right now going on, as all of you know. So one is the general accounting standards, which is what is talked about here, and then you have, of course, the IND AS, where the net worth of the company, if it is more than 250 crores and it is a listed company and all that, and if the holding or the subsidiary falls under any of the criteria, then you have the IND AS applicability. So the difference primarily between AS and IND AS is largely, if you can see in the approach. Okay, AS is largely considered to be a rule-based accounting standard, whereas IND AS is considered to be a principle-based accounting standard. The primary difference, of course, would come in the way you treat foreign exchange, for example, and then the way you treat revenue itself. Because if you see in AS, we have AS 7, which sets down the rules for recognition in case of construction contracts. So it says if the 25%, etc., all those criteria are given there. And then, of course, in terms of intangibles also. So especially in terms of goodwill, and then in case of research and development expenses. So there are all rule-based, where it says it can be amortized over so many years and all that. But in case of IND AS, or if you see each of these and you compare it, what is IND AS has given you. IND AS is largely saying it's given certain criteria. So if these criteria are fulfilled, then you can do the treatment this way, otherwise it is not. So it's largely principle driven there. Okay, this is very visible, especially in case of the intangible treatment, and then in case of revenue also. And again, very typically in estimates, the standards on estimates and contingency. So 3 cases where it is very predominantly you can find out this difference between AS and IND AS. And certain other standards, of course, there are certain standards which are not there in AS at all, like for example ESOP, which was brought through IND AS for the first time for us. So IND AS, you could say, is largely more current or concurrent, reflecting what is the current scenario, business requirements. So IND AS has been more agile in reflecting those aspects. We are catching up on AS, particularly with the revisions which have happened in the last 2 or 3 years. Okay. Now, when we talk about if you again see interplay of accounting and auditing standards is what. So as you all know, accounting standards, we've talked about what is the need for the accounting standards, how the accounting standards are there. If you talk about the structure of the accounting standard, okay, basic thing is that accounting standards need to be adopted both by the management and the auditors. So what we are doing as auditors is primarily ensuring that the management prepares the financial statements in accordance with the accounting standards. That's a primary responsibility there. So it's not just auditing. If there is a non-compliance to the accounting standards, like Sir was saying, when he was talking about gross negligence and all that. So the thing is, our primary responsibility is to ensure that the financial statements are prepared in line with the accounting standards, because as you know, the primary objective is to ensure uniformity, consistency, etc., that we talked about earlier. And in terms of so the adoption, the way the accounting standards has to be done, from the primary recording itself, from the primary accounting itself, a lot of things have to be put in place and structured. So one is when we review the GL accounts itself, when the accounting happens, transactions happen itself, we can see in case of certain cases, especially for FA, inventory, foreign exchange. These are easily, you can standard implementation can start right from the recording of the transactions itself. It's not that it has to wait to the financial statements for you to see the impact or do the changes there. So that is one aspect. And then if you see the standards, typically it has had 3 broad sections, you could say, any accounting standard. One would be that, of course, the primary is applicability of the standard, which is always given there. And then the second is, of course, your recognition norms. So how do you recognize this particular item? So that is the recognition norms. And then the third one is the measurement norms. And then the fourth is the disclosure norms. Each of these three are dealt with in depth in all the accounting standards, and we have to follow each of these. The primary, the focus, a lot of focus is also on the measurement and the disclosure in the financial statements. So that there is a lot of focus on that there. And reporting requirements as per the accounting standards, if you see, the disclosure norms are like, for example, in case of contingencies, for example, in case of derivatives or financial instrument disclosures that you need to do. In case of revenue recognition in terms of IND AS, when you talk about, you also have to talk about what is the unrecognized revenue portion there, and there is also the disclosure that you need to give about what is the if there is any customer exceeding 20% of the total revenue. So just to give an indication of whether the dependency is on a particular customer or not. So those kinds of things actually bring in a lot of visibility in terms of what, not just what for the current year, but it also gives a lot of visibility on the possible impact on the financial statements in the subsequent years. And in these cases, there may be sometimes, where you need to have certain estimates made. So that again is addressed a lot through accounting standards, and there are also the auditing standards which talk about how to deal with estimates, judgments and all that. There is a lot of guidance that the auditing standards per se, they give it to you. Okay. As you all know, I'll do this, the applicability of the accounting standards per se, if you see. There are small and medium sized companies. So of course there are corporates and listed entities where it is all mandatory. But as far as the accounting, the applicability for other entities are concerned, there is a definition which is of what is a small and medium sized companies and what are the standards and how they apply. You have level 1 and level 2 and level 3 entities, and what is the standards, to what extent they are applicable for any of these level 1, level 2, level 3 entities is already given here. So these are all the criteria here for level 1 and level 2 and level 3. These are largely, if you see, the criteria is based upon your turnover criteria or the borrowing criteria. So the strength of the balance sheet or the P&L determines the applicability of the accounting standards for each of these cases, especially in case of non-corporate entities. Okay. When we talk about interplay, when we talk about interplay, like we said already, both the accounting and auditing standards are established based on certain established principles, right? The accounting standards, again, they try to give you a guidance on how the transactions need to be accounted correctly and what are the disclosures that need to be made in the financial statements. Whereas the auditing standards, if you see, they largely guide you on how to audit the financial statements. So the framework is on verification of accuracy of the financial data which is basically presented. And of course, as an audit report, we will comment upon the financial statements conformity with the accounting standards prescribed. So this is one primary responsibility that we have. Okay. And if you also see, the auditing standards primary focus is also to identify discrepancies and misstatements due to error or fraud. Okay, like for example, in case of related party transactions, right? The accounting standard on related party transactions basically talks about how to identify it basically gives you a definition of who are the related parties. Again, you have to correlate it with what is given in your Companies Act, and then what are the disclosure norms of related party transactions, what are all needs to be disclosed and all that. But in case of the auditing standard on related party, the primary focus is on fraud and on identifying on the completeness of the transactions relating to related party. So how you go about identifying whether all transactions of related party have been brought into books, identified, and ensure that you disclose them. So that is a major challenge, and that is where the guidance comes in. And again, the primary focus there is what are the possibility of a misstatement of fraud that can happen there, right? So it's not enough if you conform with the accounting standards. Here auditing goes one step higher and also looks about risk of material misstatement and fraud angle also. So the focus is therefore on identifying discrepancies and misstatement. And the guidance and preparation. So accounting standards also talks about how to prepare the financial statements, disclosures. We have seen that. Just thought that we can give some examples. Okay, if you talk about in terms of what is the interplay? Interplay part, if you see, primarily is this. The thing is, basically, if you see, this is the point. Audit findings are used to improve the financial reporting practices. So wherever we report any discrepancies there or any inconsistencies there, so at the time of auditing, we actually find out that any lacuna that the audit accounting standard is also not addressing. So there are still a lot of business practices, still a lot of industries, verticals where the accounting standards have not yet been established. Like for example, oil and gas. Right, you still go on the basis of the guidance note there while you're doing the accounting and the auditing there. Again, in case of insurance also, it's only recently been issued. Banking is still something which is still a work in progress. So very NBFCs, of course, finally we have adopted the accounting standards there. So industry specific treatments, you know, because the business scenarios are very different. So how do you treat a particular thing here? How do you do it there? So all those things in agri, for example, all those cases, this is accounting standards are still yet to come. So in all these cases, in the absence of the accounting standards, we are largely guided by the guidance note, as you all know, right? So I just thought maybe we can link a couple of accounting and auditing standards and see the implication there. One is, of course, we can start with the simplest one, probably on valuation of inventory. So valuation of inventory, primarily the accounting standards, it says the primary objective here is that the value which has to be disclosed in the financial statement is right, correct, is fair. Now, it also talks about various aspects like how you can have to value the WIP, the net realizable value of stock, how to treat the interest and borrowing cost on the inventory, provision for obsolescence, all of these are there. So if you see here, all the others are pretty straightforward, but if you talk about provision for obsolescence, that is where a lot of dependence on the management is there, because they would have identified what is the obsolete stock, and sometimes technical people would their involvement would be required on identifying whether the stock is actually obsolete or not. So there you actually depend upon the work of others here. So the standard on work of others will be applicable in that case. So when you are depending on the work of others, so the auditing standard is actually telling you what are the factors you need to consider. For example, what is the competency there, and how are they evaluating the accuracy. We may not be able to comment on the accuracy, but how do they arrive at what are the factors they have considered, what are the assumptions they have made. For example, in actuarial valuation, typically all these factors have come in. So what are the assumptions that they are making? We can actually do the testing there. As part of statutory audit, in fact, we take up actuarial valuation. We see what are the assumptions which have been given by the management in terms of employees there, and then the attrition rate. All these are assumptions which are given by the data given by the employees. There are certain assumptions which have been made there, and based on those assumptions, the actuary actually does the valuation, and of course the fair value part is also added there, present value factor considered there, and then he gives you the what is the provision to be made or the value of the actuarial liability there, he comes up with that number. So here there are two things here. One is there is a fair amount of estimate which is involved in this process, and second part is also that how do we also disclose in each of these. So that is again given the accounting standard itself on your employee benefits. So whether those are all adhered to or not. And then 3 is the fair value, whatever he is considered, whether it is okay or not. So these are 3 things that we will actually be looking into when we do that. And so if you see, based on accounting estimates, fair value accounting estimates, it gives you a guidance on what are the aspects that you'll have to look into and see whether the fair value is right or wrong. Again, in terms of revenue recognition, here also the primary thing is assessing the risk of material misstatement here, because here the timing of revenue recognition and then the amount of revenue recognition and uncertainties, if any, these are the 3 points that we keep addressing here, and the 3 points we will address. So our risk, so the focus, so the auditing standard actually helps us in keeping the focus on the risk of material misstatements primarily. So you go back to the auditing standards, you understand that every time the risk of material misstatement and how you assess the risk of material misstatement is always driven down in each of the standards there. So, and it will help us in assessing in each of these cases. And again, if related party disclosures, of course, I told you before, employee benefits we have covered earlier. And I also wanted to talk about, again, cases like ESOP, where the calculation is done, there is again an estimate on the rate of the percentage which needs to be done, the model which you need to adopt. All these things are again factors which can be variable, and the accounting standard tells you exactly what to do. And the auditing standard here that is primarily applicable would be the general quality standard and the risk of material misstatement again coming in. So if you see, in conclusion, accounting standards give you the basics on how to account, and the auditing standards tell you how to audit, especially wherever there are estimates involved and when there are judgment involved. So it talks to you about how to make informed judgment, and so those are the guidance where you have. And of course the auditing standards also ensure a lot of other things like independence of the auditor. It's very important that the auditor independence is ensured. Quality standards are there. Then you have the documentation standards which have come out. So if we adhere to all of this, it will ensure completeness of your audit and also ensure that the audit is also conducted in a very standard and in a very structured manner. So that's where your auditing standards help you largely. In the actual practice, in a structured manner, how do you implement each of these cases? So any other specific questions you have, because it's more or less so you have any specific questions, we can take it up. Yeah. Okay. So I hope it was your morning was a little it was a little helpful and knowledgeable. Thank you for the opportunity. You have any questions, you can also reach out to me on my personal ID. Thank you.
Thank you, ma'am, for this insightful session. We truly appreciate the valuable time and knowledge you shared with us. We'll be taking a short tea break. Following the break, we will be having an exciting panel discussion. So please be by 11:15. We can come.
Argue with about saying that institute has not allowed NAFRA third body to come in as a regulator. Yes, they have. It has. NAFRA has come in, and NAFRA is there to stay, and NAFRA is going to ensure that the auditors, the KMPs, the directors, everyone is doing whatever it is that they are supposed to do. To put it in a very simple form, whatever it is that I am supposed to do as a independent director or as a statutory auditor, whether I am doing it properly, And what we should all understand is that we always have regulators looking at us over our shoulders. Okay, always you should be aware that there is a regulator, be it a charter, the ICA Institute, be it the MCA, be it the IBBI, be it the courts, or be it the NAFRA. Someone is always looking at us over our shoulders. In fact, in the morning you would have heard of C.A. Rajendra Kumar talking about the disciplinary committee of ICAI. So, and what you should all understand is all these mechanisms, it's very easy to actually start a process against a person. Okay, you just have to make a complaint. NAFRA, of course, they go through their various inspections and audits, and they ask you for papers. It's a huge process. The FRRB is also a huge process. The QRB is also a huge process. But the disciplinary mechanism of any regulator is very simple. You just go to the website, click, make a complaint, make the payment, and then the system starts rolling. And once it starts rolling, you will find that you're spending a lot of time defending yourself. You know, in most cases, the complaints may be frivolous, but you're deemed to be guilty unless you're proved innocent. And it is up to you to prove that you are innocent. So my own feeling is that, you know, it's always better to err on the side of caution, be very cautious, ensure that whatever the regulators say, whatever is expected out of you, you do not cross the boundaries of that regulatory aspects in whatever we do. Once we do that, then our quality of work is ensured, and also the regulatory overview over whatever you're doing is going to be that much dilute. So I think now I'll hand over the proceedings to our C.A. Chinnasamy sir to take it forward. Thank you.
Thank you, ma'am. You actually set the tone of the leader of Southern India Regional Council of the Institute, and the most of the concerns which the chairperson has explained is that at one point in time the audit profession was considered as a very important profession, nation building, etc. And nowadays, if I am talking about statutory audit, the first question which is coming from the practicing chartered accountant is whether I have to continue as a practicing chartered accountant or I will move on to some other activity. This is mainly because of the fear which has been created by the regulators. And we also work, sometimes I think that we work on, it's like a knee-jerk reaction. Only after something has came into the public, and if the regulator is prescribing certain things, then only we are serious about taking that as forward. But I always believe that practicing with a fear, both for the preparer of the financial statement as well as the auditors of the financial statement, is unwarranted, is my very strong feeling, because as long as you have followed the due process in your audit, if you are the auditor of the entity, and if you have followed the due process in the preparation and presentation of financial statement, if you are on the part of the management in presenting the financial statement, perfectly all right. But the question is, what is the due process? It is only there the real problem starts. What we assume that this is what an established practice which I am following as an auditor, and what the regulator presumes that this is what is also the role of the auditor, creates a problem. But one thing which we have observed, maybe in our close study group of some of the chartered accountant friends, when we were looking at the AQR, Audit Quality Report issued by NFRA, as well as a lot of cases where cases have been referred to NFRA, and NFRA has identified or maybe concluded that the auditors have not completed their professional activity properly, and accordingly either they have been debarred or they have been penalized, etc., has happened. When we are reading all these reports of NFRA, or maybe around 80 cases where they have concluded that the auditors are found guilty of professional negligence, as well as the AQR report which they have published so far for mostly for all the big accounting firms and also for another accounting firm, plus one mid-size audit firm also, they have published an AQR. In all these things, when we study, what comes out from the regulator's side is that if you have carried out the audit and document the work which you have performed in accordance with the standards in auditing, they believe that the work is properly done. If there is no proper audit evidence which you have collected and you are not able to demonstrate through your audit documentation, immediately the conclusion which the reviewer or the regulator draws is that you have not carried out your work at all. I still remember one example which I can talk about, one case where we were defending the chartered accountant when show cause notice has been issued by NAFRA. The question is relating to a related party transaction which the NAFRA has felt that based on a complaint it was not properly done by the management, as well as the auditor has not considered the possible fraud risk involved in that particular transaction, whether it's a diversion of funds. This is the area where the NAFRA has took the particular case. But when you look at the SCN, the show cause notice, almost it is running to 30-35 pages. Almost all the standards in auditing, right from SA 200, what is your basic requirement before you start doing an audit? SA 210, letter of engagement. Like this, they are going on talking about various standards and says that there is no audit evidence or documentation available in the work paper file of the chartered accountant, and accordingly they are concluding that the auditor has not carried out this particular job. Interesting point is, one of the comment which has made as a basis for concluding the auditor is found guilty is SA 505 on external confirmation. The auditor has actually gone through the entire minutes of the audit committee, entire minutes of the board, and the shareholders' approval relating to the related party transaction, because the transaction was beyond the threshold limit of the audit committee and the board. So it has gone to the extent of the shareholders' approval. Shareholders have also approved it. It's a listed company, but not very active in the market. And that company has mentioned that we have followed the due process for carrying out. The auditor is keeping all the copies of all the minutes in respect of the related party transaction has been properly approved, and it is very clearly known to the shareholder, including the person who has made the complaint. But on the contrary, they have gone to the other work paper file, whether this particular amount has been confirmed with the party who has received that money. The auditor has, it is a period of 3 years they have picked up. Auditor got a confirmation of balance for the first year, and the same amount continued in the second year, same amount continued in the third year. Third year he got the confirmation of balance, but second year he has relied on the confirmation received through the management. That means he has not sent a direct confirmation letter and got it from the borrower, and because of that they have said that you have not followed SA 505, whether this loan is actually existing on a particular date. Let me put that 31/3/2022, 23 and 24. 22 he got the confirmation directly, 24 he got the confirmation directly, 23 he has not got the confirmation. Same amount is continuing even in 24. After 24 there was a settlement based on which they have actually settled the amounts also through a scheme of arrangement. So money is also fully collected subsequent to the period of audit. But what NAFRA has actually observed that 2023 you have not got the confirmation of balance from the party, and to that extent you are not able to demonstrate this amount is outstanding as a receivable in the books. Auditor was trying to explain, 22 I got it, 24 I got it, in between no transaction has happened. 24 when I have got it, it's fine. But they have mentioned that each year is a separate audit. It's a discrete financial information. Your audit documentation should have been based on that. That was the starting point, and from that 505 they have picked up all other standards and related everything and found the auditor guilty and debarred him for 3 months and also levied a penalty of around 25 lakhs. When we have gone for the appeal, automatically the issue was in favor of the auditor. It has finished, that is different. But why I am saying that is, what we are looking for and what is the expectation of the regulator should also be kept on the back of our mind. I believe that it should not be the only fear which we have to have in doing it, because even the best audit firms, or maybe we can say that the audit firms who are worried only about documentation, have also been part of the review. And some of the audit firms in their AQR report, they have said that they have not followed a lot of information, including the main worry on fraud and main worry on going concern assumption. So this is the way in which people are saying. That means we will not do our work in accordance with the requirement of a regulator, but we will continue to do our work in accordance with the due requirement of the standards on auditing and the accounting standards. When this particular panel discussion has came in, we are only going to concentrate mainly on the aspects of financial reporting. That means it's on accounting standard. In the financial statements, what are all the gaps which has been considered, or what is the expectation which users are having, but what is the expectation gap which is prevailing, and what the regulators have observed. Maybe that gives us as a guidance for the purposes of moving to the next level. Not necessarily NFRA, we have so many other reviewers also, FRRB, we have even peer reviewers will also guide you on what is your documentation issues with respect to application of technical standard. Technical standard includes standards on auditing, but on the other side it also includes the accounting standard. That's the reason why we are having this. And of course, another way in which we are looking from the angle of the management and the auditors requirement is how the audit committees are expected to perform, whether the audit committees are really performing or not. You might have come across a lot of media news where they are saying the independent directors in the audit committees have not expressed their views, or they have not raised their voice when something has gone wrong or something has been put down as an agenda paper, but they are fully not comfortable with that particular agenda point, but they are keeping quiet. So dissent is not recorded. So how the audit committee can be more effective for the purposes of ensuring that the financial statements are 100%, or maybe I can say 5% we always consider as materiality, and 95% whether they are in compliance. That's the reason why we had this panel. And we have very good panelists with us, Mr. Chandramohan, both as part of the complete financial reporting team of TAFE, one of the very big conglomerate, and he led the finance team for years together. In fact, when I started my career in one of the big accounting firm, I started interacting with him from 2005 onwards. And after the retirement, he becomes in the board, and he sits on the other side of the table as well. So his experience will surely of help and create a lot of value addition to this. And similarly, I asked Revati ma'am also as part of the panelist, because every time when we are going and meeting the professionals, the first worry which is coming in, you as part of the regulator's side, that is regulatory sides from the standard setting body of ICAI, and you are leading the southern region, which is the biggest region in the entire 5 region. What is your view on how the regulators are looking at the auditors, the management in preparation and financial statements? So I thought that her presence will also be helpful, how we will be ready to face the challenges and common pitfalls. And Mr. Lakshminarayanan, known to us for many years as chartered accountant as well as independent director of listed companies, his presence will also be helpful in understanding what is the way in which the regulators are expecting this. We actually wanted to have one more panelist. Unfortunately, last minute they have withdrawn. So accordingly, I can give you a good news that you will have a little bit of extra time for your questions rather than only our questions to the panelist. So my first question is to Mr. Chandramohan. Sir, NFRA is actually assessing the competencies and compliance sufficiency with respect to the accounting standard and of course on the auditing standard as well by the listed companies and large unlisted companies. Do you agree the process being followed by NFRA, and what is, in your opinion, normally the common pitfalls from the point of view of the preparer of the financial statements, and how the auditors has to gear up to the expectations of both the corporate as well as the regulators side, sir?
Thank you, Mr. Chinnasamy. First of all, as chairperson said, NFRA is here to stay, so I think we have to accept it. When I was chairman of Tamil Nadu CII, I used to travel a lot. I'm talking about 4 or 5 years back. I used to take representation from all the industries and go to Delhi and meet them, etc. And then I always used to ask them, various people whom I used to meet, including the ministers, look, sir, you're coming out with so much of, amendments and all that, which impacts all the companies. So why are you punishing the companies who are also, absolutely okay and all? So he or she always used to tell me that, look, the law is not made for 98%. The law is always made for the remaining 2%. So unfortunately, you may have to comply with it, or if you're already complying with it, be happy about it. So that's what it is, after all. So I think, as the chairperson said, NAFRA is here to stay. Just, I think it also improves the stakeholders' I would say confidence. To give a very recent example, I'm sure, in fact, I met him recently in my office also, the IND AS managing director, and he was, of course, he wanted to help us. Of course, we don't borrow. TAFE as a company, we don't borrow. Touch wood. So we were talking a lot of things, and he wanted to help us. He wanted to actually expand the business of the TAFE. Now, what happened in this InduSInd Bank, I don't know how many of you would have, I'm sure you would have read it. This company, actually took a lot of foreign deposits from the NRAs. They took almost 45,000 crore, which represents 15% of the total deposit of 6.4 lakh crore. What they did was, the person who actually was handling the operation desk, he passed on to the trading desk to actually provide a hedge. The trading desk, what should have happened, which is very, very surprising to me, the trading desk, instead of course, banks, it do happen. Let me also tell you this, and I'm sure who are auditing the banks, they'll know it here. The trading desk, instead of taking an external hedge, they took an internal hedge, which means they notionally booked the gain without actually hedging it outside. So that was the real issue. As a result of which, when the rupee depreciated, at that time, I think it was, 79, 80, and now, of course, it moved up to 87, now it has moved up to 83, probably the loss would have come down in the books of InduSInd, I don't know. But the total loss as reported is 1,900 crores, which is almost, 1/4 of the profit of the company and 2.5% of the net worth of the company. It's a large exposure as far as the bank is concerned. And most importantly, the confidence of the people on the bank, to some extent, if I can say that in a mild manner, comes down. So I think it's very, very important that, the controls and the systems and the processes have to be not only perfect, but also to ensure compliance is the same. And sometimes it happens. For example, we know what happened in Yes Bank. We know them well, but unfortunately, now of course it's getting slowly revived. But we know what happened. They just took a large exposure. At that time, Rana used to meet us and used to talk a lot about it. And you will be surprised, just before the bank, I wouldn't say collapsed, the bank became almost a defunct bank. 1 year back, CRISIL, we know CRISIL rating, how tough it is. I don't know whether people have gone through. CRISIL rating is one of the toughest rating. And we have gone through that several times, just for the sake of understanding how strong TAFE is, because we were not borrowing then also. So, they were rated the best as far as governance is concerned, just 1.5 years back by CRISIL, and the whole bank got, whole failed next year. So, why should it happen? So you can keep debating, discussing for a long time. Slowly it's coming up, so hopefully, but for the infusion of the capital by the various banks, these banks would have collapsed actually, honestly. So that's how they survived. So I think, for example, I think Fortis Hospital, they actually reported excess cash and the profit was not okay. So, unfortunately, while these incidents are sporadic and far and few, these do happen, and these do weaken the not only sentiment of the market, but actually erode the investors' confidence, erode the, let's say, the faith in the system, and therefore probably, this type of regulators like the RBI supervising the banks and the NBFCs, etc., may be required in order to ensure that the system goes on. It's like, you really, don't cross the signal because the policeman is there watching you. Therefore, you don't do it. It's like that.
Sir, actually very interesting to know from the point of view, because you made the statement very, very strongly that the law is made for 2% and not for the 98%. And the problem which we are actually facing it, when they made the law for the 2%, the balance 98% is also inadvertently getting involved in that vicious circle. That is the reason why people are worried. But one good thing which we were talking about, and SAR also has very strongly advocated in this theory, is when the regulators are going to stay, are we going to worry about the regulator, or we are going to worry about what is the way in which we can build the confidence of the stakeholders? So that is ultimately is the aim of the corporate, that is ultimately the aim of the professionals also. So accordingly, when you have quoted the example of IND Bank, Yes Bank and other companies who have collapsed, you made the point very clearly by saying that the major focus should have been on compliance and on the controls which the entity should have in respect of preparation and presentation of the financial statement. And automatically the compliance with respect to the accounting standards will follow. So, and in the process, the confidence of the investors, the confidence of the ordinary stakeholders will also be taken care. And in fact, you have given me more confidence that we need not do an audit with a fear, but we have to do an audit as a professional. So that's a very good point which is coming from you, sir. And my next question, supplement to this NFRA, because we talked more NFRA, and we also have our own internal review, that is Financial Reporting Review Board, which selects the financials, published financials on its own and initiates the review to ensure that whether the auditors have complied with the requirement of the technical standards issued by the institute, various laws, and whether the entire audit is proper or not. So for Mr. Lakshmi Narayanan, you might have learned the various reports which has been issued by FRRB. My question is, for the benefit of the audience, can you just tell us some important, consistent deficiencies which has been noted by FRRB in financial statements, and what is your recommendation for the preparers of the financial statement as well as the auditors to overcome these issues which are repeatedly being reported?
Ever since FRRB has been started in 2002, they have been reviewing annually about 100 to 150 reports, and they have been finding out quite a lot of errors or loopholes in the presentation of financial statements. To name a few, I have, in fact, I have a lot of things, but a few things I will describe. See, first is insufficient disclosure of accounting policies, incorrect classification of current and non-current assets, inconsistent depreciation policies, exclusion of related party transactions, not naming the details of related party transaction, especially about the quantum, the relationship, and the tenor, the terms, other terms like rate of interest, etc. And in some of the cases, the EPS, they are not considering the what do you call the diluted equity portion. They are calculating it or disclosing it wrongly. These are some of the basic errors that they are mainly pointing out. There are other non-compliances mainly coming from our IND AS 108 segment reporting, the lack of proper disclosure of the segments. As I said earlier, related party transaction, not giving proper list of related parties. The other details like the terms, the tenor, etc. In which case, wherever there a loan is given, and EPS, as I said, and again the leases, especially accounting for leases under IND AS 116. they're wrongly reporting they're wrongly accounting. The basic structure is not being properly depicted in the annual report.
Sir, thank you for listing out at least the what we were normally worried and what could be the possible way of going ahead. You mentioned 2-3 points very important. One is the related party transaction not being properly considered by the auditors to ensure that there is no fraud risk involved. That is one of the major concerns every review is pointing out, whether it is our own review or external review. Even when in cases of the audit committee also, the related party transaction assumes a major significance. So you have rightly pointed out that is one area where more work has to be done by the auditors and the management to make it very clear. And current and non-current classification still is a doubtful area of people. And you also mentioned that the revenue recognition is one of the issue. And more than that, you have also mentioned about the disclosure related standards not being properly followed. Normally we believe that when we are talking about accounting standards, only the accounting standards which has an impact on the balance sheet or on the profit and loss account, we have to be much worried, because if there is a material misstatement, that has to be reported by the auditor. If the auditor is not reporting, then automatically his audit report is not properly having a basis for conclusion. That is the way in which everybody is looking at. But unfortunately, if you we normally miss out one important point, is that if you look at SA 705 in respect of modification in an independent auditor's report, it also talks about one issue as a pervasive issue, and if it is material, the auditor should consider even an adverse opinion. That is disclosure of key information or disclosure of major information which will be relevant for the users to fundamentally understand the financial statement. And accordingly, the disclosure relating to related parties, disclosure relating to leases, disclosure relating to cash flow statement, a lot of comments are coming in relating to cash flow statement, and disclosure related to operating segments. These are all normal issues which we believe not an accounting issue. Profit is not affected, so we are not bothered. But even if profit is not affected, you are not actually bringing out what is to be known to the user of the financial statement, and the important disclosure is actually pending. And that is the reason why FRRB is also sometimes comes with very serious comments on what should be the way in which we have to look at the preparation of the financial statement, doing an audit, keeping the audit documentation, etc., etc. Thank you very much, sir, for making it very clear on what it should be. Because he was mentioned about the classification of financial assets and financial liability as one of the major issue. I wanted to ask the next question to the chairperson. How companies, in your view, are typically err in classification of financial assets and financial liability under Indian accounting standard, and what has been the response of the regulators in respect of that? Similarly, in what ways do the companies usually go wrong in testing impairment of goodwill, impairment of non-financial assets? Because these are all the areas where there could be material misstatement and there could be problems relating to understanding of the financial statement.
Yes, sir. Like you, I think, asked about erring in the classification of the financial assets and liabilities under IND AS. So I think that, this erring happens even in, companies which are not under IND AS. Okay, and here today we are discussing about the accounting standards, so we are talking about the IND AS. So what happens when you are classifying an asset, a financial asset or a liability? What is the, what we are bothered about is the current assets. What is the current and what is the non-current portion of these assets and liabilities? And I think that, what happens is, even when you're doing a listed company audit, the amount of information which is available to you is going to be enormous. so voluminous that unless and until you're going to use the aid of some tool, and now we fall upon a lot on AI also, and even if we are applying AI using the tools, we have to actually apply our own natural intelligence and do our test checks to ensure that this classification between the current and the non-current portion of the assets and liabilities are whether under IND AS or not under IND AS are done properly and correctly, because ultimately what we are doing is we are going to ensure that whoever is relying on our financial statements is actually not misled to or takes any conclusion which is not going to be useful to them, whatever is the conclusion that they want to make. And the other part of your question was, I think, what is the impairment testing? Sir, impairment testing, I think, is another grey area, and something that as professionals we all also sometimes get a bit confused as to how we are going to, because I understand whatever is the size of the entity that we are auditing, ultimately we have to sit with the management, okay, and there should be a consensus between the management and the auditor as to what exactly is happening. How am I disclosing? Management is not going to agree with the auditor in most of the cases. And Sir also spoke about SA 705, and even though today is an accounting standards day, we cannot not talk about auditing standards. Okay, your auditing standards and your accounting standards are always going parallelly. Okay, and we should ensure that they meet at some point, that there is a consensus, there is an understanding between the play of the auditing standards and the accounting standards, because what happens, you do not agree with the management about the impairment testing, you do not agree, what do then? You ultimately have to give it in your audit report. Somewhere everything is going to boil down to that audit report, which is either going to come in as an emphasis of matter or as a qualified opinion, or and ultimately what does the management want? They want an opinion which is not qualified. They want a clean audit report. Wherever you go, even you go for your regular bank audit, what do they ask? Is it a clean report? If it is a clean report, they just don't care. They say, okay, fine. So long as you give a clean report, we are happy. But if you don't give a clean report, what happens? And this clean report, qualified report, is where the regulator is going to check. Okay, the regulator wants to know how you gave a clean report, even though you should not have given a clean report. I have issued so many standards. Okay, why haven't you followed this standard? Why haven't you ignored the auditing standards? Why have you not read those? In fact, if you see our essays, there are even detailed illustrations as to how you should word your reports. So I think that as I'm speaking here as a regulator who has issued all these standards. Go through the standards. There are guidance notes also which are given. Go through the guidance notes, go through the case studies, go through what has happened, go through the NAFRA's website has in detail every single order, how they came to the order. And if you see nowadays, whatever are the orders which are released by any regulator, they are all speaking orders. So we don't actually need to do too much of back study, forward study, go back to everything. It is there as a speaking order, and once we go through those orders, they're all self-explanatory. FRRB orders, they're all self-explanatory. So it's all on public domain. We don't even need to go through an RTI to get these. It's all available on public domain. Go through it, but what I always say is that please do not forget, always be aware of the regulators looking over your shoulders. They are there, sitting here on both these sides. One side you have the institute, one side you have the other external bodies. Institute is your basic mother body who is registering you and who is actually entitled. Like you say, in my house, my parents will actually discipline me, right? That is the institute. But when you go outside to your school, to your profession, you have other agencies who are actually dependent on your work, and they are going to oversee whatever we do. So we should always be conscious of the regulator, whatever be the nature of the work, and never forget the interplay between the standards, the auditing, the accounting standards, and all other acts which we are supposed to be compliant with.
So I would like to add one
Yeah,
point
please,
here.
please.
With regard to impairment testing, I think it is better to have at least, especially for listed companies, to have at least 1 quarter valued by, the valuation done by an external valuer. Normally, I think every quarterly results, it is the company which does the valuation and say that it is everything is hunky dory. I think, see, look at it. See, the assumptions definitely we can question. When you look at the valuation, I think you look at the future projections, the terminal growth rate. All these things are definitely meant for is easy for manipulation. And if the growth rate is say more than 5% or 6%, 5% is a maximum that is allowed. In practice, there is no law regarding valuation of terminal value. But I think if it is anything beyond 5%, the normal story is it is GDP's growth rate is a pegging rate for that. Anything less than 5%, if the supposing management says I will take 8% growth for the terminal value, it is definitely not acceptable, and I think we can definitely question that.
Perfect.
And so it is always better at least 1 quarter go for a third-party evaluation, especially from a registered value.
Yeah.
Thank you.
So, two panelists have expressed their views. Revati ma'am has pointed out whether you are following accounting standard or you are following IND AS, the current and non-current classification remains the same, perfectly correct, because the rules for classifying an asset into current and non-current is same in AS as well as in IND AS, similarly for the liabilities also as well. And she also pointed out the main problem is how we are classifying a financial asset or financial liability and what are all the challenges which are coming in. For example, many companies wanted to use fair value through profit and loss account as a classification or fair value through OCA as a classification for financial asset and financial liabilities. For financial asset, you have one more classification called amortized cost. And there are very clear guidance which has been given in the standard itself. For example, IND AS 32 very clearly mentions at what point in time you can decide that one should go to amortized cost model, one can go for fair value through OCI model, when it can go for fair value through profit and loss account model. It talks about two criteria, whether what is the business model of the entity on one side, and it is also talking about what is the cash flow characteristics of the instrument or the liability or the asset as the case may be, based on which guidances has been very clear. But the problem is, if I am using fair value through P&L, I may have a fluctuation in my profit on quarter-on-quarter basis, and accordingly many wanted to use fair value through OCI model. Perfectly all right, but your business model has to demonstrate your, what I should use the word, solely payment of principal and interest criteria for the characteristics of the instrument should also be satisfied, then only it is possible for you to use this. Debt instrument, you don't have a problem. But when it comes to equity instrument, there is very, very clearly mentioned that unless this falls into that, you cannot straight away go for FVOCA. That is fair value through OCA. But at the same time, they have also given an irrevocable option for classifying every equity instrument as fair value through OCA, but comes with a lot of stringent conditions. Even the profit on sale of the final instrument could also be accounted only in OCA, and you cannot take it to the P&L account when you are making huge profit on disposal of that particular instrument. So if we follow the guidances which has been given, and Madam from the regulator's point of view has also stressed upon the guidance note issued by the institute, the educational materials issued by the institute, the application guide which comes as part of the accounting standards, the Indian accounting standard, education material, even standards and auditing, all these points when you are strictly following it up, it will be helpful that you will never get into the trap of a wrong classification or making a error in classification of the asset. The second part of the question which we were discussing is that on the impairment of asset. I always believe that when I am going to the management and say some of your assets are impaired, it is like I am going to my wife and say that over the years your beauty has lost. So you will know what would be the impact arising out of that, right? And I still remember that in one audit committee, we have started with a discussion, not even audit committee, we started with the discussion with the lower level on impairment of one of the non-financial asset. And that discussion was not agreed by the CFO, and then it was not agreed by the group CFO, and we don't wanted to give it up because the company was continuously incurring losses. We took it to the audit committee. Audit committee has understood what we are trying to emphasize, and they said that they let the financial statement to be redrawn. Because when I am having continuous losses and I don't have what is the possibility of recoverable amount. Recoverable amount should come by means of a binding sale contract. There is no such contract. You should create cash flows out of your own use. That is also not happening. Then how I can say that the carrying amount is fully recoverable? That was the point which we were discussing, rightly supplemented by Lakshminarayanan sir. When this model is being worked out, impairment loss valuation has been worked out, normally the numbers can be very easily adjusted with an Excel assumption being changed, even by 0.25% or 0.002% also it is possible. So accordingly, relying on the work of an external valuer is what is his suggestion. I also wanted to confirm his view, but at the same time wanted to make a caution also. Not necessarily that every time we have to go for external valuation alone. Depending upon the seriousness of the issue, depending upon whether the auditor cannot exercise his judgment or his expertise on valuing certain things, relying on the work of an external valuer may be required. But again, as rightly pointed out by the representative of regulator sitting here, the moment I talk about an Indian accounting standard, automatically the standards and auditing follow suit. So if you are going to use an expert or external expert, there is a standards and auditing how you have to evaluate the work of an independent expert. That is also which you have to look at. And there also some problems which we have seen. You relied on the work of an external expert. Based on the external valuation obtained, the management believes that this is fully recoverable, will not be okay. Have you validated the basic assumptions? Have you validated the base data which has been provided to the external valuer? Have you tallied those numbers with the books of accounts? All these things are additional requirement. That is a very interesting point which is coming on impairment. And at the same time, a lot of questions are coming on the independent directors and directors sitting in the audit committee. Because why I am using independent directors is audit committee normally the composition should be major is by the independent directors. So they are saying that the role of an audit committee is to ensure independence and also the capabilities of the auditors and the effectiveness of the statutory audit which they are performing. So accordingly, I have a question for Mr. CHANDRAMOHAN, especially because he sat on both the sides. One on the side of a director and checking whether the auditors have effectively carried out their function as part of the audit committee, and the other side in the previous stint as the preparer of the financial statement. I just wanted to ask you, sir, in your view, what is the audit committee's role in maintaining the independence and the effectiveness of the statutory auditor? And that is actually being expected by NAFRA, the reviewers, even Companies Act 2013 as well.
Thank you, Mr. Chinnasamy. I'd like to flip the role if you don't mind.
Yeah, please.
See, basically, in my opinion, we cannot be preaching unless we practice it. So, what we did in TAFE, for example, I don't want to trace the history for the past 25 years. See, we are very strong, I would like to claim, we have very strong, robust process and systems. For example, we have 90 processes. We have divided this into broad 4 areas. One is called design to delivery. Second is, lead to cash. Earlier we used to call it as order to cash, but now we are calling it as lead to cash, basically because the generation of lead itself, we are trying to bring a process which is going to be automated. Then of course procurement to pay, and then the record to report. Record report, of course, everybody knows. We got some, out of this 95 process, 20, 25 are in design to delivery, 25, 30 are in procurement or lead to cash, and then the balance maximum, of course, in the record report. So if I can, let me try to explain, if you don't mind, just one or two, so that it will be useful to the audience. It will be useful for you. Exactly. See, for example, I'm talking way back, some maybe 12, 13, 14, 15 years back or more. We found that our systems were, of course, working on MRP, but it was not so robust. Meaning, we had a basically BOM, which is bill of material, as you may be aware. We had different BOMs. For example, we had one in design, one in production, one in purchase, one in spare parts. So there were a lot of issues, lots and lots of issues, and therefore, I don't know whether Chinnasamy remembers those days, and there used to be definitely some issues. So we said, nothing doing. We shall have only one BOM. So when we brought in Windchill, which is basically for design and development of the product, I don't want to get into details of the Windchill, etc. Basically, we connected the Windchill to SAP. And then we said, look, we'll use only one BOM. So over a period of time, what we did was we completely ensured there was only one BOM. For example, every tractor has got some 1,800 parts, and some of the tractors have got even 2,000, 2,200 parts. Therefore, there were issues. But then we said, nothing doing. We shall not allow this, and we'll have only one BOM. And over a period of time, for example, today we make almost 600 models of domestic, and we have a couple of 400 models in exports. And therefore, at this time, I think it was some 300, 400 in domestic and 250 in exports. Even at that time, it was large. So we have completely streamlined, and we ensured there's only one BOM, and the BOM is flowing seamlessly across the system. So what happens as a result of this, when we run the MRP, and as a result of which, okay, I don't want to get into the details of MRP, like going to forecasting, etc., but then we'll have to go into further more details, which time may not permit. But what we have ensured in the process is, the inventory is absolutely accurate. There's no question. Of course, we have a perpetual inventory, and most importantly, we ensure that the aging is absolutely clean. We really rip the people apart, if I'm allowed to use the words, that if it exceeds even, let us say, 180 days, forget 365 days. So therefore, our systems and processes, we ensured it's absolutely robust. Just to give an example. To actually migrate to differently, we took over we have also got of course, out of our 13,000 crore plus, roughly 500, 600 crores interior plastic division, which we're trying to expand. So we took over for Asia recently the interior plastic division. So this is a multinational company, and therefore we thought the systems and processes are robust. Unfortunately, they could not even give the aging of the stocks when we took over. And we relied upon, they said, look, the French people told us that, look, I used to discuss day in and day out with them along with my boss. And, she gave it to me, she asked me to negotiate with them. So I was doing this negotiation, and they told me, look, the systems are perfect, and therefore there is no problem. So I took it on face value, because I thought, French company, multinational company, being in India for a long time, it's a close to $18 billion company as far as the global is concerned. So we thought the systems are okay. But then when we took over, we realized that systems were not okay. The aging was absolutely absent. System, of course, SAP does not automatically give aging, but it's very simple to take an aging statement from SAP. All you have to do is develop it very quickly. So, the MRP system was not followed at all. And the people used to argue with us, particularly with me, because I was overseeing the division, till the cows come home, that, look, we cannot follow it. We have exports left and right and right, we have color, we have different models, they are supplying, we're supplying to Renault, Nissan, we're supplying to, of course, Hyundai, Kia, etc., name any. Most of the car manufacturers except Maruti and Mahindra were supplying. So, they used to come and argue. We said, nothing doing. You shall follow MRP. It took almost 1 year for us to implement this MRP. Today, I can very confidently tell you the inventory system is absolutely robust. The aging is perfect. But it took almost 1 year for us to clean up the system. So all I'm trying to say is that the systems have to be developed internally by us. Auditors, with due respect to auditors, all the people who are sitting here, all the people sitting here, unless we give you a perfect system, unless we give a robust system, I don't think whatever you audit, may not be effective at all. So therefore, then you can only, of course, point out deficiency, and then as she rightly says, if you come and say, everybody wants a clean report, so how is it possible, It's not possible. Pricewaterhouse and Deloitte compete with us to say that, look, we want the audit of TAFE, because they know that it is one of the company which they can audit, without any issues. See, we, for example, for Touchwood, we have a large cash balance, okay? So we actually recently decided to give this audit to CRISIL, and we wanted an external opinion from CRISIL. So they went through thoroughly. It's a couple of thousand crores, so therefore they went through very, very thoroughly. So we have a very, very strong, I would say, processes there also. We have we invest in 15, 16 mutual funds. We very clearly say, if the mutual fund size is so and so, we can only invest so much. We should only invest in AAA rated papers, etc., etc. We have a very detailed board followed robust system. So they went through everything, and they actually divided into 3-4 criteria like credit risk, concentration risk, etc., etc. So they went through the completely the portfolio, and then they came out and said, look, we're not able to find any fault with you. So for example, if the credit risk is, let us say, the best for, let's say, less than 6, ours was some 2 point something. If the well diversified number is 26, we were some 14 or 15. So they were not able to. So it's all because, in our opinion, of course, it behoves on us a lot of responsibility. It's not that we're talking with pride, we're talking with a lot of responsibility, that if your systems and processes are okay, which is followed just not in finance, it is followed in marketing, it is followed in design, it is followed in supply chain, it is followed in, of course, legal, it is followed, of course, in finance. Then in my opinion, the auditors, comfort level goes up significantly. We have, for example, a CRM which has a very detailed dashboards as far as marketing is concerned, so they can understand what is happening at the dealer end sitting from our office. They don't have to go and visit the dealers. They can understand. Of course, they can go and verify. The auditors certainly go and verify the year-end stocks, etc., not only at our end, sometimes the dealers end also. But we have not found any discrepancy at all in the past, I would say, several years. So therefore, it all depends upon your systems and your processes. And if they are robust, and if you fine-tune it, for example, there are certain systems which we are trying to automate today, which has nothing to do with auditors, for example, talent management, etc. So therefore, it all depends upon how you improve the systems, how you improve the processes, and how you give comfort to the auditors. For example, we give a very, very free hand to the internal auditor. Forget the internal accounting standards, he gets into details. He tells us there are some 56 or 57 acts from Apprentice Act. So from the Apprentice Act, the accounting standards, if I can say so, he thoroughly does an audit, and we give a thorough free hand. Even when I was the CFO, we used to tell him, fine, if there is a problem, please raise it, and if it is pointing out towards us, let it be rectified, because that's the only way you improve. Otherwise, you don't find, you go and improve the system. So we give a complete thorough free hand to the internal auditors, which is discussed threadbare in the audit committee. For example, we do not tolerate, to give a very mundane example, if I'm allowed to say that mundane,
yeah, please.
The gate entry delay is more than number of hours, we don't tolerate. If let us say gate entry exit is not there, we don't tolerate. So we take it so seriously. So it's all a question of evolving over a period of time, but it's not that we're just talking in the air. The systems and processes are very clearly documented and circulated to everybody. So when the new person joins, he knows what is to be complied with, what is to be followed, and therefore he needs to, of course, we keep improving the systems and processes. So most importantly, in our opinion, if your internal systems, if your internal controls are okay, then the role of auditors becomes that much more easier. That's what I would like to say. Of course, we have to go through the selection process, but then most importantly, it actually is more internal than external is my call.
So thank you so much, sir, because it's very, very clear communication how the audit committee should carry out its functions, especially when he says that it's more of internal rather than external. Auditors comes next. So whether I kept my house clean with robust process and systems, and he also talked about how the effectiveness of internal audit helps in ensuring the compliance with various laws and regulations, and this is fundamental. So when you expect the effectiveness from the auditor's point of view, when I kept my house clean and it is completely disciplined, naturally the auditors will draw their comfort, and then nothing to worry for the auditors. And of course, the auditor will have their own documentation and other things which they have to carry out according to the standards on auditing. So to some extent, they will also ask for a lot of evidences. But only thing which I always believe is that whether you do an internal audit, whether you do a statutory audit, you should not be disturbing the business as usual, because unless there is a business, if there is no business, there is no role for the auditors coming in. And accordingly, from his experience, I take this as a very good takeaway for today, that as long as the bringing robust controls, compliances, etc., internal to the system, that is through the board and the audit committee, automatically the statutory auditors will be effective. So that's a very strong and very good communication which we have received from you, sir. And having said that, there are certain areas which are being normally discussed in audit committees, in the board, and sometimes there is a difference of opinion between the auditor and the management. And I am taking two areas, and mainly because of the disclosure requirement, how we should prepare the user of the financial statement for a future event which may occur or may not occur. That comes through disclosure of contingent liabilities and contingent events. Similarly, we have started talking about, as a passing comment, on related party transactions. The disclosure of related party transactions, the way in which identification of related parties and the transaction with them, and whether those transactions are in the normal course of business or they are one-off for the purposes of making some financial statement adjustment, etc., is always a concern which we are having. I wanted to ask Mr. Lakshminarayanan, from his role as an independent director, what is your view on the shortcomings which you find in related party transaction analysis as well as contingent liability disclosure analysis, and what do you believe that will be the remedial process for having a proper financial statements?
See, I answer the first part as far as related party transactions are concerned. Normally the related parties list is actually with the secretarial department. I think as an independent directors as well as the auditors, I think we have access to those numbers. But let's take one particular case, Zeal fraud that has happened in 2018-19. That's once again with Z Entertainment and Entertainment Limited, which actually wanted to go for a loan with Yes Bank, for 200 crore loan for Z Mobility. What happened? They asked for it's a startup. They asked for a collateral. They said Subhash Chandra said, I think you can take the deposit that is with the Yes Bank of Z Entertainment, and the loan was taken. This has happened without the knowledge of any of the audit committee members or even the board. Subhash Chandra they handled this independently. It is done maybe with the connivance of few top officials. It was not disclosed. How will the audit committee members or the board of directors come to know? It's very difficult because they don't meet often. They don't see the day-to-day accounts. Auditors might know. Auditors should have flagged off. This is the biggest mistake the auditors have committed. They have not even disclosed. And finally, when SEBI found out, it came to light. So then they say audit committee, there is an oversight. But see how 200 crores deposit is foreclosed without the knowledge of the CFO, without the knowledge of other audit committee. This should have actually gone through the audit committee for being a related party transaction, and also the board because promoters are involved. So this has happened without any basic formalities. How will the internal auditors miss this? We don't know. How the statutory auditors missed? We don't know. What is how all these people are they conniving? We don't know. But the reality is they should have gone through this. The material transaction, if the management is not sure, I think it's better to take a certificate from the CFO that none of the major transactions have been missed. Otherwise, internal audit, independent directors will have no way to find out all these things. Yes, sir.
Yes, sir. Then on contingent liabilities, I would like to have your views.
Contingent liabilities, and you see, one of the FRB's recommendations, findings on contingent liabilities with respect to GVK Industries. See, GVK is, as we all know, it's a very big conglomerate into infrastructure, entertainment, and in fact, they are the company who are managing Mumbai International Airport. See, what happened when these companies, they are into large, high-value contracts, they failed to disclose the material claims. See, they have actually FRB observed about 6 points. One is material claims not disclosed. What happened? See, the tax demands and service obligation dispute, this is not disclosed in the annual report. So, actually, Ind AS 37, which says even the probability of outflow is low, the standard requires the disclosure claim is, if the claim is material, it has to be disclosed whether there is any probability of the contingent liability becoming a actual liability. Second point is inadequate description of description and quantification. When the contingent liabilities are disclosed, the nature of dispute, amount involved, current status were not at all explained properly in the notes and accounts. And there no mention of timing and possible financial impacts taken to Schedule 3. And the previous year's contingent liabilities carried forward to the subsequent years, and no notes regarding the current status of those liabilities. That is also one of the findings. And the MD&A, there is no cross-reference between notes and accounts and MD with regard to this. These are the observations. And of course, as usual, they came upon audit committee and statutory auditors for the lapses. These are major findings of contingent liability disclosures by FRRB. Yes, I think it is definitely, again, see what is happening in the reality, as far as the audit committee or board meeting is concerned, we go by the agenda and we presume, and whatever the information that you are giving is the only thing that will be discussed. But how do you, every time you cannot ask 100 to 150 questions whether this guarantee is included or not, what is the status of the last year's, it is very difficult, because audit committee meetings or board meetings are over a couple of hours, where sometimes the management and auditors and internal auditors and statutories also give some presentation about their findings. Hardly we have very little time left out for discussing or probing into all these things. We have no time for probe. Unless, I personally feel there should be a pre-audit committee. Pre-audit committee which is not recommended by the SEBI or LODR, but it is better to have a pre-audit committee meeting and discuss with the auditors. And maybe with the last year's accounts and the current year major transaction we can discuss. And better it should be also be minuted and recorded in the audit committee meeting, which is going to be held for consideration in the accounts.
Yes, sir, please.
See, again, I'll go back to the point of, strengthening the systems and processes. For example, as a company which is into, let's say, auto, and most of our group companies are into auto components and they do supply to TAFE. So arm's length becomes very important. So, for example, he knows it well, Chinnasamy. So, Simpson supplies all our engine requirement to TAFE, and they hold 76% of our shares. But what we ensure, and they keep grumbling as a shareholder, not as a shareholder, but as a major shareholder, that their price is lower than actually what they supply to Sonalika, which is the other tractor company. Of course, we keep complaining that, look, why are you supplying to the competitor? But they said, look, this is competition and we have to do it. But when we ensure that the price is always 1,000 rupees lower, and our argument is that, look, you supply most of the engines to us, and therefore your overheads should be less, and therefore it should be less. So it all depends upon, your, again and again I'm telling you, it's all depends upon your practices, your systems and your processes. We ensure, for example, that if there is because touchwood doesn't happen most of the times, but if there is a problem, then we ensure that the MSMEs are paid exactly on the 40th day 100%, but we delay Simpson payments. Okay, and they grumble again. So it again all depends upon your ethics and your practices, your systems and your processes. We ensure 100% of the confirmation of balance is obtained from the group companies, and we know that the age of that also is absolutely okay. So again and again, whether it is related party or whether it is joint venture, whether it is subsidiary company, whatever way you are associate, whatever way you want to call it, it all depends upon how you basically follow the processes and systems.
It's a good point, sir. In fact, I have almost written the similar lines to supplement Lakshmanaran, sir. Identifying the related party itself is a challenge for the auditors. It's not only for the audit committee, even for the auditors it is a problem. So maybe the starting point could be the disclosure which the compliance officer of the company is having from each of the directors and taken on board. But if they are not disclose certain matters inadvertently or intentionally, and there are transactions which are happening, so again there is a problem. That is the reason why we always believe that the internal control system on certain areas should be very, very robust to ensure that completeness of the entire related parties who have been identified, and then making your audit procedures to identify whether it is arm's length, whether there is any other issues relating to that, is it really happening or not happening. So I believe that the responsibility is, like he has mentioned, the audit committee meets not every day, but the auditors are having more time at their disposal. Perfectly correct, but the auditors will also have limitations. That's the reason why I always preface that if you wanted to ensure where there is a judgmental area, or you believe that it is, you still have a doubt that have you completed your process, please ensure that your entire audit documentation is in accordance with the standards on auditing and other technical guides. For example, for related party transaction, we have a separate standard on how you can validate the related party transaction, and there is an application guidance which is available to explain to you how you can actually mitigate the possibility of making an error on that. On the contingent liability also, Lakshmanaran sir has very strongly explained what are all the possibilities where you will miss out, and in my thing is two more additional points which we used to have. One, take a declaration from the management that what is the show cause notices and other orders or proceedings initiated during there as a starting point, and that is an explanation given by the management. You corroborate that with your audit process, then document it. Show cause notices, if you are not considering as a contingent liability but you believe that the amount is very, very significant, you also think about whether you have to make a reference that show cause notices where no demand has been confirmed or not considered in this evaluation as well. Similarly, one suggestion which I have seen from my experience as audit committee chairman of a large private bank and also NBFC, what I am saying is that whenever we are talking about this type of disclosure requirement, material or not material, etc., etc., we should also look at from the SEBI's LODR disclosure point also, because as per the standards on auditing, you will conclude that it is not material, but the LODR requirements are completely different. Whether you have complied with that materiality disclosure as well is an important point. So that is an important area of consideration, related party transaction and the contingent liability. Coming back to again to the chairperson, I wanted to understand the gaps between NAFRA's reporting requirement and the reality of challenges facing the statutory auditors and the statement preparers. I don't just wanted to say NAFRA is 100% correct on their approach. I wanted to say that you have your expectation, your requirement, perfectly all right. Have you looked at the aspect from the side or putting you into the shoes of the statutory auditor or financial statement preparers as well, whether there is any gap between this requirement and what is the real challenges statutory auditors are facing is point number one I wanted to check. How far the auditors and the companies are translating the various advices they are getting from FRRB review, because the moment FRRB is making a review, it also comes out with a publication of common errors found out in the financial statement. How they are translating, the auditors are translating that into the actual work, and the management also how they are taking it. Maybe we would like to have your views on this.
Yes, sir. Before that, I just want to digress a little. I just want to, take forward what Sir was telling us now, Chandramohan Sir, that there is always this competition between Deloitte and PwC to take over their audit. Sir, I think that after today, everyone in this room will also be a part of that competition. We are all actually it was very nice to hear the governance processes and the other, the seriousness with which the audit committee is actually reviewing all the reports and your reliance on the internal audit reports also, instead of internal audit actually being a mandatory requirement which is being fulfilled. No, normally if you see, we also do a lot of internal audits where it's a checklist, tick, 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 not tick. High, low, medium, whether it's a high, low, medium, they'll say, no, can you shift it to low? See, this is what we say, always wherever you go, everyone wants only a clean report. So it's very heartening to see a company which is, giving the due importance to all that is mandatorily required. It's instead of just being a checklist. So on that lighter note, I wanted to tell you, it's not only 2 firms who are going to compete, all of us here are going to compete with them. And, so moving on to what is the gap between the NAFRA's requirement and the auditors' compliance of this. I see there is, there should be a balance between how NAFRA is actually expecting. It is like, when you go to school, you'll have a very, very strict teacher who is going to immediately take the cane and say, okay, come, I'm going to punish you. And someone who's going to give you a little bit of time. Okay, they'll say, okay, they'll understand that you have a problem. So NAFRA, I think, is very strict disciplinarian, and there is not much of, as far as I have gone through I've gone through a few orders of NAFRA also, where, there is a very strict mandated or very strict expectation of compliance with all the mandated requirements, right? Whereas we as auditors, whether you're a big firm, big, small, large, medium, whatever is the type of firm, we do have our own reliance on our internal processes, internal procedures. I will give because ultimately what it is we as partners will delegate the work to our team, and we rely on the team's work because we have certain set procedures, we'll have checklists, we'll have templates, we'll have audit programs, and we'll ensure that these are all complied with. One, it is satisfying the need of an audit trail of maintaining the papers, and 2, it is also going to give me a comfort that what and all is required to be covered by me, complied with by me, which in turn is the compliance by the corporate whom I am auditing, whether it has been complied with. But here what happens is that slight difference in view when NAFRA feels that this reliance on templates is excessive. What happens normally, it's like your reliance on AI, where you are not actually understanding what are the risks which are involved in depending on AI. Similarly, reliance on a template ensures that what needs to be complied with is complied with, but whether we are missing out something, that fine difference between the two, whether we are missing out those two. And 2 is again, IND AS is very complex in most situations, and especially the larger the company is, the more complex it is going to be. Whether there is enough automation of the IND AS applications. Okay, now suppose you have a revenue recognition problem. I have this revenue recognition even at the regional council level. We do have this debate on revenue recognition, or whether your collection of fees is going to be at a point in time or at a period of time. What is going to happen if the course is going to extend, from this last quarter of one financial year to the next quarter of the financial year? How are we going to recognize that? So whether this kind of revenue recognition is going to be automated. So what I gave was a very small example. So if you're going to extrapolate it to a huge company like, say, a Lever or someone like that, an FMCG company, how exactly are they going to do it? And ultimately, again, as an auditor, when we are sitting, we are always, on the other side, like Server said that today he is going to swap places. The management, how is the management going to react to whatever you are going to disclose? Ultimately, that is what is the limiting factor for every auditor. Okay, whether if this, a medium-sized auditor is more bothered about maintaining that relationship with the auditee, right? You want to have a continuing relationship with them. Even if I'm an internal auditor of TAFE, if sir is going to tell me, why don't you just tone down this a little, I would say, yes sir, definitely I will tone it down, right? You want to continue the relationship. These practicalities are also going to impact us to a very large extent, and I think that there is a very fine line where we are going to decide as to whether we are going to step across or maintain our own standards. That fine line is ultimately dependent on the auditor themselves, whether it is going to, result in the regulator actually coming down rather heavily on you, and how far you're going to go ahead with that. Sorry, sir, the second part of your question was?
So FRRB is making a lot of review comments. How the auditors and the preparers are considering that, whether there is any change which is coming in their approach, or they are simply ignoring that?
Yes, I think that FRRB comes out with a study every time, and they have found that there are some implementation of their recommendations, not 100%, but there is a partial implementation of their recommendations.
Okay.
Yeah.
So it's a good approach that when we were saying that audit documentation in some of the accounting firms are the greatest audit documentation, the observation of NAFRA is excessive dependence on template itself is not correct. So your tick box approach is not the expectation of NAFRA. In fact, what I have been taught right from my BCom days about auditing is that audit is nothing but a common sense. And if you are able to ask 10 relevant questions with respect to anything, it's not just questions, relevant questions. Why I am talking about 10 is, first question may be giving a little bit of idea. When you start using probing question at the 10th, you will be completely clear about what exactly you wanted to have as an objective. What is the conclusion you wanted to draw, you will be very clear. So just using a template or checklist alone will not help, is what is coming out from NAFRA's review point, as well as what is emphasized by the chairperson. One thing which I could not even now not able to understand, whether the audit fee should go in accordance with the IND AS 115 or it should go to as per AS 9, whether I have to go account it at a point in time or over a period of time. Because many of my friends used to say, we normally consider audit fees till such time it is collected as a contingent asset. Okay, so I'm not very sure about the accounting treatment, what is in your mind. And the interesting point which chairperson, that is the way in which we are expecting the words of wisdom from the leaders, is that everyone here should be a challenge for other two firms to get a good audit like TAFE. Not necessarily only TAFE, any good audits where the companies are putting robust processes inbuilt, we should be able to compete with them, so that it's a pride to work with them. That is also coming out from Madam's point of view, so that is interesting. And I have one question, sir, because nowadays Madam has also mentioned about artificial intelligence. So I just wanted to go into that, because we believe that the financial reporting, future of financial reporting is believed to be process automation and use of AI to collect all the data and then using it in a proper manner in accordance with the compliance of the laws and regulations, standards on accounting. And what in your feeling is that regulatory expectations relating to use of AI or analytics in audit and financial reporting?
In digress for a minute, I think I met one astrologer, I think he's sitting here, am I right? Who's also a chartered accountant.
Oh.
So my first question to him was, look, we always look at the sky and decide not, of course, Chennai sky, but all over the country, basically because we sell tractors not in Chennai, outside. So I requested him, can you please predict the monsoon? Because what I've been reading and what I've been discussing with various people, including the bankers, the monsoon is supposed to be normal. But he said, look, don't take it for granted. The monsoon is not going to be okay. So, like, word of caution to all the people who wanted TAFE audit. We are a cyclical industry. We go through really, definitely ups and downs. We're going to export a lot of countries. We were exporting through ACO. We are going to export directly, which is giving us definitely interesting, challenging opportunities as well as, of course, a lot of issues. So I think, every company will have its own issues. Okay, that is on the lighter side. To talk about, AI and data analytics, I think, to the best of my knowledge, AI has still not been used in a big manner, and I don't think SEBI is sort of favoring that. If I'm allowed to say that, they still say that it has to be taken with a word of caution, and therefore I think AI is still to take up. But as far as companies are concerned, I think there is a lot of progress. For example, we decided to do robotic process automation as far as procurement to pay 1.5 years back, and we have almost, when I say almost, basically because as far as direct purchase is concerned, we have been able to implement not only in TAFE but even the divisions of TAFE, including the subsidiary company. But as far as the services are concerned, we are still in the process, and I think it will take a bit of a time because of the processes being a little different. So I think several companies, I know large companies, whether it is L&T or Tatas and all that, they've definitely moved to a much bigger, I would say, automation. We are attempting to do that. As I mentioned to you, we have a very robust CRM, but as I mentioned to you, there are certain processes like lead management, etc., which we feel there is a scope for automation. As far as auditors are concerned, as I know, they use a lot of data analytics. While AI, they are still testing. For example, they were telling me some time back when I asked them, they said, look, sir, we are doing this very small piece of invoice being uniform. I think there is some way to catch up as far as AI is concerned, as far as auditing is concerned. But a lot of data analytics is being used as far as audit is concerned. They use a lot of tools and then come back and tell us that, look, which of course we do it very thoroughly in our company. So I think, it's a question of, I would say, strengthening our view or fortifying our view, whatever you may say. So they do in terms of inventory analysis, they do some, for example, concentration of risk in terms of sales in particular region, particular dealership, etc., which we are all aware of, but they do it in their own way. So data analytics is being used by auditors, whether it is in sales or in purchase or in finance. For example, they have a very good tool to say that, it's a very interesting tool. They come and tell us whether any entries are passed by, I think a lot of people know here, Chinnasamy knows Mauli well. So whether senior vice president has passed any entry in the year end. Similarly, whether any entries are passed during the month end or on the holidays. Similarly, whether any large entries are being passed after the book closure. So I think they go through this type of very thorough analysis in terms of, certain checks and balance to see that there are no, let's say, any unusual entries in the books. So these type of analytics, they have started doing it. And I know they have been telling us that, look, sir, we want to expand this data analytics and we want to do in now so many other fields. So I think data analytics is here to stay. They will start doing it much more. AI companies have started. Audit firm, I don't know, honestly.
A good point, sir. Actually, I wanted to listen from you on AI. Even audit firms are started working on AI, but it's very expensive investment which they have to think about it. And what would be the outcome arising out of that, they are not very clear. But the use of automation process, robotic process automation, or using that as part of your data analytics will definitely help the auditors identifying a particular trend. We have seen some good examples. He has talked about some entries which has been passed without the proper authority, or the person who is supposed to authorize is passing an entry is taken as an exception, and the entries passed after the office hours, the entries passed on a holiday, entries which has been the person who has generated the entry is the approving authority, right? That if we are looking at a lot of things are easy for the auditors to understand, including validation of non-standard journal entries. That's a way in which using data analytics for the audit will help. And your data analytic tools and how you have documented your work performed using your thing will also make the NFRA to feel that we are not just taking audit for the sake of doing an audit, but we are very serious in doing our role as a statutory auditor. Thank you very much, sir, for giving that as part of our learning today. And for Mr. Lakshminarayanan, I have some interesting question, because ESG is coming out as one of the important development where the environmental, social and governance related matters for every company to report. And of course, audit on the ESG reporting is also becoming a requirement for the top 1,000 listed companies in India according to the SEBI requirement. So I would like to understand how it is matured and what is the expectation of the stakeholders, how the auditors are ready for it.
See, actually ESG reporting is not mandatory. I think it's only called business responsibility and sustainability reporting is mandatory.
BRSR.
And that is only meant for top 1,000 companies in terms of market capitalization. And if you look at it, this, in my opinion, I think the BRSR is not taken up very seriously because nobody is signing it. Nobody is signing. Who is responsible? Actually, I am in the board of listed company. I don't know who is taking responsibility. End of day, I think it is another, as of now, it's another tick box matter. There is no ESG audit which is mandatory, but some companies are adopting voluntarily, like top-notch companies like Adani, these Infosys, Tatas. They have a separate ESG report in addition to BRSR report. Tata Power, in fact, they submitted a 20-page ESG disclosures apart from BRSR. There is an integrated report done by Infosys. Only top-notch companies are taking it seriously. Other companies, I think they have to mature. And today, I think we are not ready for BRSR. Definitely not ready for BRSR. I think see, one thing that what's happening today is BRSR is submitted in XBRL format, and it is not being monitored even by the regulatory authorities. But one day they will wake up. 2-3 years later. Today, if you look at the number of frivolous things that are coming out now, for example, if you don't have mentioning registered office address, your MCA is penalizing. Not appointing independent directors, MCA is penalizing. Same thing is going to happen for BRSR after a couple of years. It is all in XBRL. It is easy for analysis. So, as far as I am concerned, BRSR ESG is now only restricted to top 500 companies. Predominantly large cap.
Yeah, please, sir, your views on this.
See, I think it's not to be brushed away. It's a very, 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 very important subject. And to my mind, I think institute should strongly take it up with the MCA and say how to make it mandatory for, like, I think accounting standards are applicable for above 500 crore net worth, am I right?
IND AS is 250 crore.
250 crore. Okay, 250 crore, sorry. So I think like that, you people should take it up and lobby, because it's a very important subject. For example, we took it up only 1.5 years back. We engaged Pricewaterhouse, of course, a different wing. They did a thorough consultancy work for almost 6 months, and we've taken up very strongly about it. For example, today I can straight away say more than 90% of the power is from mill. Water is almost, okay, I don't want to get into details of our sustainability, but I think every company, it's very important, basically because it will have a huge implication on accounts. For example, Tata Steel does it very robust manner. They, for example, publish it in a very detailed manner. They are actually moving to what is called direct reduction method, basically using hydrogen, and they are definitely quantifying and saying that, look, what are the assets they have which could become obsolete because of environmental changes. They have even taken, I would say, if I'm allowed to use the word I would say not risk, they've taken the challenge of taking a green loan, which is linked to the metrics of the performance of the company in respect of environmental issues. Levers, Hindustan Levers, there is a huge implication in case what happens to the agricultural product. For example, you were talking about astrology, but it's a real fact for us that, if something goes in Rajasthan or in Gujarat or something happens in Bihar, we have an issue. We have a huge issue on hand. So I think, the impact of that environment, impact of that sustainability is becoming a very important issue. And I think it's going to be more and more impacted. So I think, okay, you may not be able to, let's say, play a large role. Companies have to play a role. But I think, if you can push it, bring those standards much more robust, then the companies will also take it up a little bit more seriously. As he says, maybe several companies are not able to do it because of one, affordability, basically because the regulations are not strong. Multiple reasons are there. I think therefore it becomes in the interest of the nation that you people really take it up through MCA, come out of the guideline which should be applicable, as you said, from 250 crore, whatever numbers you mentioned, and see how do we really implement this over a period of time.
Very good supplemental comment, sir, because ESG is being taken very seriously by organizations, even though there are not enough guidances which are available, but we are learning from the other countries and then trying to implement that. And at one point in time, that becomes an important aspect, because when we do our business, when we do our industrial activity, we have a sustainability of even availability of raw material, power, etc., is the point which has to be discussed. That is the reason why ESG is picking up, and maybe in a few years right from now, we will see that it is matured further and further, as explained by Lakshminarayan sir. And the last question from the regulator side, which I wanted to ask to Revati ma'am, is that one of the normal concerns which people will be having, or regulators are coming out heavily on the auditors, is they have not considered whether the company will be able to continue at least for the near future, at least for next 12 months. We call it as a going concern assumption is not being validated. Majority of the companies where there are frauds, the companies have become NCLT companies, CARP has been implemented. The regulators are coming out heavily on the auditors that you never assessed the going concern assumption of this particular entity. How you believe that, how the firms have considered to be defaulted in making an assumption or validating the going concern assumption, and what is the reaction which you believe the regulator will come heavily further on the companies on this?
Yes, going concern is something which needs to be considered very seriously. But before that, I just wanted to give my little bit on the BRSR and the ESG which was being discussed. So to all the professionals out here, I want to say that BRSR reporting is again going to be one of the most mandated requirements if you are following the SDGs. SDG also emphasizes, one of the 7 SDGs is emphasizing on this ESG implementation. So how, if you see, SEBI has given us the BRSR as a mandated in its LODR. So the BRSR certification course is being offered by the CA Institute. So before sir said, why don't you as a regulator ask MCA to make this mandatory for 250 crore companies? I would suggest that all of us be ready by doing the BRSR courses, because if you go through the checklist which has been issued by SEBI, you will see that each and every single point needs a lot of drill down, and which can be done only by an auditor. Okay, don't let all the work be taken away by other consultants or other big firms. We are all equipped to do it. Do the BRSR course, and you can always all approach the bigger companies, the 250 crore companies, the companies who cannot afford the bigger firms, but who do. There are a lot of corporates which do a voluntary compliance where we can go and offer our services. This is one opportunity which I think that all of us as chartered accountants need to grab the opportunity while it is still fresh and hot off the regulators' books by the issuance of standards. So the query which sir asked me was about the going concern. See, why I told you, when we started off this discussion itself, I was talking about why do we need an accounting standard to ensure the uniformity in reporting. Okay, uniformity in understanding at whatever level a financial statement is being prepared, whether it is for a small company, a one-person company, or a multi-crore, a billion, or a listed company, whatever it is, the same format should be there. Why? Because the stakeholders are actually relying on whatever is the statements which are prepared by us. And going concern is one thing which is basis on which the financial statement is prepared. Now, if the company is not even going to have any credibility, it's not going to be a going concern. If there is going to be serious concerns on by the auditor on the going concern status of the company, then I think that as auditors, whether I'm talking from the regulator point of view or from because, you can't take the auditor out of me just because I'm sitting here, right? I'm also actually a professional who's day in and day out faced this. So, as an auditor, if the company where I'm going to certify, I have doubts about the going concern, I will sit across with the management and discuss. I say, boss, I'm not able to even see where your company is going from here. You're only making a loss. Your net worth is eroded. There is no net worth at all. Everything is negative. What do you want me to certify? Okay. Ultimately, whatever it is, the financial statements, everybody is signing. Your audit report is signed by you. Right? And you have a paragraph there where you are allowed to make such disclosures and say, I am questioning the going concern. So I think that how the regulator is going to believe, if you are going to actually go on the side of the management and support them, ultimately the management is not going to accept your thing of saying that there is a negative network, there is erosion, I'm not going to certify the going concern. He is absolutely going to say, please don't come back. You give this report, you will never come back. All my group companies will go out of your thing. All these things are there. You are in a very tough situation, but it is between the fire and the frying pan, sir. You have to decide whether you want to take up the fire or the frying pan. Wherever you go, I would decide to stay with the frying pan itself. I want to be on the side of the liquidator. I do not want to have any negative connotations on my brand as a chartered accountant. Okay, because ultimately that is what is going to give us go through with me throughout my life. So that
perfectly correct. You have to make your own choice. I still remember in 2011 November, hardly 7 days to complete a tax audit and transfer pricing audit. When I was part of a big accounting firm as a partner, I had started having a lot of black spots before my eye. I went to the doctor. He said that there is a retinal detachment, so we have to immediately go for surgery. I said I have 7 more days to work for my client, so I finish off and then I will come. The doctor has said only one thing, perfectly all right. I think that I have explained what are all the consequences. If the retina has actually rolled up, there is no replacement, there is no artificial items which are available, and you will be completely blind. So he was very categorically, you will be completely blind, your one eye will not be going to help you, and you have 2 choices before you. You have to select between your profession and your blindness. Tell me what you wanted to do. And I said, my profession can wait. I will ask my partners and other people to take care of that. I will immediately come for the surgery, because sometimes you have to think about what is important from the perspective at that point in time. Not necessarily losing one client will be the biggest issue. If you lose one client, automatically you have opened up your time for another good client, right? That is the way in which we normally look at the aspects. And I think that we have come to the closure of the questions which I have prepared for the panelists. If 1 or 2 questions, if the audience is having, I will be taking up before I formally close this panel discussion. Any questions? Yes, sir.
So my name is Abhishek. So sir, I have a question with all the panel members. Sir, as Chandramohan sir rightly said that the rules are made for the 2%. And he also mentioned one of the case like the IndusInd Bank, what happened in that, and the question was straight away raised to the auditors as well. So that case was not, what I suppose, 2 months old, but 2 fortnights back again the same similar case happened with the Gensol and the Blue Smart, wherein the SEBI has raised serious allegations against the promoters. And again the finger is being pointed out at the auditors only, because the nature of the financial irregularities has been reported in the findings of the SEBI, gives a clear indication that there has been the audit lapse, or maybe the management was involved. But the questions again is being put up on the auditors. So how do you think, sir, the NAFRA is going to tighten more grip on the auditors, because these things are not stopping at all, even institute having a regulation, then NAFRA is also sitting on our top. But the things are not stopping, and more irregularities are coming up with more seriousness. So
okay. Sorry, on behalf of the panelists, I take this question because it is a very important aspect which I believe that connected with the approach of NAFRA as well as the how the professionals are looking at. The first point which I wanted to tell you, as per SA 240 on considering fraud risk in a financial statement, it very clearly communicates if it is an orchestrated fraud by the management or override of controls by the management, no audit tool could find out. Unfortunately, I'm making it very clear, unfortunately, this is not going into the mind of any regulator. Starting from what SEBI has done an inspection on even Satyam scandal or whatever we are talking about, anything which you are saying, because a fraud normally comes out after a period of 6 years or 7 years at one particular what you call there is a burst and you find out from that angle. So unfortunately, the audit tools with all the reliance which we are supposed to place on the integrity of the management and our internal controls which is being used by the management, etc., is the starting point for the auditors. As far as I am concerned, when you said NAFRA is sitting on our head and NAFRA, how it will tighten this further and further, unfortunately, I am having the view, it's a purely personal view. I have the view that NAFRA is actually doing more than what is expected from NAFRA, and they believe that all the auditors are not having the quality of being an auditor. So that is a wrong presumption with which every review is being done, is what I am having. I can give lot of evidences from the various convictions which they have made, saying that a small lapse, for example, one auditor has been barred for 5 years just because of one single thing. Up to the previous year, the company was in accounting standard. The next year it was in IND AS. The auditor's report was mentioning about Indian accounting standard as prescribed under section 133. In the basis for preparation, they have mentioned that the financial statement have been prepared in accordance with Rule 7 of the company's accounting standard rules 2006. So that means it's a usual clerical or a typo error of copying and pasting, which is in the DNA of everybody, right? So previous year financial statement has been copied, pasted, and it was not amended. By oversight with so many people reviewing it, it has gone. NAFRA has said that you are supposed to report on Indian accounting standard, but you have report, a company has prepared as per AS. Because company has prepared under AS, your audit report is not having any validity because you have not followed the accounting, the financial reporting framework which is mandated for the company. That type of very narrow interpretation also coming in, where the auditors have given so much of explanation, including their work papers, that they have done checklist of Indian accounting standard, not AS. Just because one paragraph available in the notes, they have concluded like that. Accordingly, if you are asking them to go more tighten, then nobody will be interested in doing the practice, is my personal view. And accordingly, I believe that whenever there is a situation like Gensel or whatever is coming in, this is a deterioration of the internal control system which is not being properly followed. The moment you follow proper internal control system and validate that, automatically your life will be easier. Unfortunately, we are not doing an audit of controls. We are doing an audit of transaction. That is where the problem comes in. If we move towards relying on the controls by validating it and then supplementing it by means of test of transactions and test of account balances, that will be a better choice. That will eliminate over a period of time. Maybe the last one.
Narayanan. One is a lot of companies are coming for SME IPOs. So there we have to get the approval from SEBI. So in what cases, lot of audit reports, so in what extent SEBI scrutinizes the audit reports, so what is their level of checking in getting the approvals?
I don't think SEBI approval is required
Yes, because stock exchange is there for monitoring the process is being done by the BSE and NSE emerge. But ultimately the approval is required by SEBI for the SME IPO. That's what my...
No, my understanding is, I may be wrong, but I think my understanding is only stock exchange approval is good, not SEBI's approval.
Maybe. I have a...
Great.
that is one thing. So in what way it is, how they are scrutinizing, whether it is maybe right, or is it BSE or NSE emerge or SEBI, whomsoever is approving. So what extent they are scrutinizing the audit reports of various companies before getting the approval status. So that is number one.
Okay.
Number two, we have been talking to this forum lot of irregularities, audit reports, accounting standards. When you say day before yesterday, the Prime Ministers have launched the Vizhinjam port in Kerala. You have seen lot of financial irregularities have been found out. Normally, this inflated cost estimates has been found out by this CAG. Then normally any concession period is 30 years for any port. There is an additional 10 years has been granted, leaving a additional revenue of 29,000 crores to the Adani Group. And there are a lot of other, the accounts which has been prepared for this by the intermediary agency is totally messed up. So these are all the things, I don't know how the CAG is going to take off for this kind of things. This is my small comment on this. Thank you.
Okay. Sir, as far as your comment on SEBI coming out on the SME stock exchanges, because nowadays mushrooming of IPOs coming on SME sector, they believe that some of them are like what is the dot-com bubble has happened long back. They wanted to make a control over that, so they are strengthening the process, and because of that, the number of IPOs which is coming in SME stock exchange now is taken back a little bit. That is what the level of applying the brake at the right point in time as a market regulator. SEBI started doing it. So that is on this. I believe that over a period of time that will also get matured. We cannot expect that everything happens on day one itself. Coming to the next one, C&AG's audit. This is something which I cannot say in every forum, but I wanted to just say that you as an auditor do an audit as if you are doing an audit of your client with. So every regulator is looking for whether the public money is properly utilized or not utilized. So they will come out with a supplemental audit or whatever, PSU audit straight away being allocated to C&AG. All those things are fine, but my personal feeling is like what Mr. Chandramohan has mentioned. The moment I am talking about the quality, it should be internal and not external. Whatever audit I am doing as an auditor, I should ensure that my quality is internal. Then only I am worried about the external regulator. If that perspective sits in our mind, automatically everything falls into the correct places is what I wanted to say. Anything which you wanted to add, sir? So thank you so much for being very patient in listening to all our questions, and my sincere thanks to all the panelists, Mr. Chandramohan taking time explaining with his own personal experience and industry experience and giving a lot of examples from their own company's standpoint and connecting it to the real life scenarios what the regulators are expecting. Thank you very much, sir, for the excellent way in which you have communicated your thought process. Mr. Lakshminarayanan, both as a chartered accountant in practice as well as the board member, he has also given a lot of insights into the expectations of the regulator, how we can be more effective as an auditor. And finally, the regulator sitting here wanted to make the first point that she is also a chartered accountant and then only comes as a regulator. So naturally, the fear which we are having in our mind is just because of regulation, whether our profession will be diminishing or it will be deteriorating. So nothing to worry. As long as we are following the guidances which is issued by our alma mater, I think that we will be able to defend each and every case where the shortcomings in financial reporting is being brought out by the regulator, or we will learn and ensure that the shortcomings never appear in the audits which we are doing. With that, thank you so much for your patient hearing. With that, I will pass it on to the moderator of the session.
So we extend our heartfelt thanks to our distinguished panelists for sharing their valuable insight, experience, and perspectives today. Your contributions spark meaningful discussion and immense value to our members, sir. Thank you. We are delighted to share that 2 handy guides are available for all the members to keep updated with the standards. Members are asked to collect their copies from the distribution counter after the lunch. So after lunch, we will be continuing with an insightful session featuring GN Ramaswami sir and Shankar Raman sir. So we will be meeting by 2:15 max. Sorry. Good afternoon, everyone. Today we have this third session by GN Ramaswami sir. Request you to occupy the dais, sir. So before we begin our session, I would like to have a short profile of GN Ramaswamy sir. He is a fellow member of the Institute of Chartered Accountant of India. He is also a qualified DISA from the Institute of Chartered Accountant of India and has completed the post-qualification certificate on IFRS, International Taxation. He is a registered insolvency professional having enrolled with Insolvency and Bankruptcy Board of India. He is also a registered valuer for securities or financial assets with IBBI. He possesses more than 30 years of post-qualification experience in servicing large and medium-sized clients in the areas of statutory audit, encompassing application of financial reporting standards, apart from advising clients on strategies for governance, restructuring, acquisition, and related valuations and tax implications. Beyond his professional contribution, he is also an active speaker at various industry forums, sharing his insight on financial reporting, taxation, and governance. Sir, we are grateful for your presence, for accepting our invitation, sir. I request CA Devadas sir to present the memento to the speaker as gratitude. Thank you, sir. Sir, I now request GN Ramaswamy to take out the sessions. Thank you.
So, good afternoon. Actually, I am told that I was introduced as a photographer, not as a professional. I make it clear, I'm into audit practice for the last 33 years, and that is my main profession, and photography is my passion. So, I will not let you down. Some of the members who are known to me closely, they told me that whether you're going to justice for this session, definitely I'll do my best. And second thing is the post-lunch session. Most of the seniors are here. Everybody would have attended the IND AS course of ICAI, or they will be applying the standards, the principles in the day-to-day life in preparing the financial statements. Then what is the purpose of this session on the standards per se? See, it's always better to read or review or hear the standards quite frequently, because these standards are having lot of judgmental issues or the concept issues. It will brush up our minds. So it's always good to hear somebody speaking, or in fact during the course of audit also we used to listen to the juniors, because they will bring some new thoughts. So in that way it will be useful for us. So and moreover, the standard is very vast. We would not have applied all the principles in our audit finalization, because we will be concerned only about the areas which is applicable to us. But when we read the standards again and again, it will give a better understanding for us. That's the reason for the Institute organizing these sessions. In fact, they initially thought of having it group discussion for all the full day session, but subsequently they decided to have the group discussion only for one session and the other 2 sessions to have a specific standard based session. That's the reason I have been asked to do 3 standards, and 1 and 0 that is on consolidation, and 27 on separate financial statements, and associate joint budget 28. So I will first take you through the accounting standard 110. This is one of the most important sessions. It is totally different compared to the consolidated financials what we do under IGAP. Everybody would have prepared the consolidated financial statements under IGAP. There it is not mandatory to prepare the consolidated financials if the company doesn't have a subsidiary. Doesn't have anything other than subsidiary. So till the Companies Act 2013 came into force, we will not consolidate if the company has only a JV or a associate. Only if it is a subsidiary having more than 51 stake in subsidiary, we will prepare a consolidated financial statement. That too, it was not mandatory for a very long period. Only post the listing, SEBI made it mandatory for the listed companies to prepare a consolidated financial statement. Then the company started following that. And now with the Companies Act 2013 came into force, now it has become mandatory for all companies who are having associates or JVs also need to prepare subsidiaries, consolidated financials, because that is also treated as a subsidiary under the purview of Companies Act. But when you come to this IND AS era, it is nothing but IFRS except few changes, because one of this standard, except a couple of differences, it is a full IFRS compliant standard. Here the consolidation is the primary thing. In India, we will prepare the standalone financial statements as a mandatory thing as per the provision of Companies Act, and consolidated will be given as a part of the financial statements wherever is required. In the globe, it is totally different. Mandatorily, you have to prepare a financial statements on a consolidated basis for the group as a whole, and only if it is necessary, you have to give separate financial statements. Mostly they prepare only for regulatory purposes, otherwise there is no mandatory requirement to prepare a standalone financial statements. That is a fundamental understanding difference between India and other part of the country. So as a part of my agenda, I will be covering upon the definition briefly, objectives on scope, key definitions, control power returns, that is the key thing for this consolidated financial statements, what is accounting requirements and consult procedures, that is mostly of accounting aspects, and what is non-controlling interest, and difference between our IND AS standard, IFRS 10, and also our IGAP 21, and also few FAQs. Depends on the time, I will go into that, otherwise I will share the presentation with you. So definition, section 121 of the Companies Act deals about the financial statements, which talks about to give a true and fair view of the Companies Act, we need to comply with the accounting standard prescribed under the Act, and also we have to comply with the Schedule 3 requirements. So unless we have to be extremely careful about the standards required. In the morning also they are talking about NEFRA's issue. The standard is more important. You have to, depends on the size of the company, we have to decide whether we are going to follow IND AS or IGAP, and accordingly we have to ensure that the respective disclosure requirement as required in Schedule 3 has been given in the financial statements. And the same section by subsection 3 defines about consolidated financial statements. In addition to the standalone, this is the only difference in India. Other countries, IFRS, if you say, this word will not be there. Here, in addition to separate financial statements, the company need to prepare consolidated financial statements. So for the purpose of this section, subsection subsidiary shall include associate as well as JV. This is company side requirement. Subsidiary company, that is defined under section 287. So a company will be a holding company of other company, or other company will become a subsidiary of other company if it controls the composition of the board of directors. Second, exercise the controls more than half of the share capital. Third, expression company includes the body corporate. So it need not be a limited company or a private company, it can be a body corporate also. So holding 50% of shares, it can be directly by themselves or through one or more of its subsidiaries. So consolidated holding at holding company level must be more than 51%. Once if it is it will be a subsidiary company of other company. Control shall include the right of appoint majority of the directors. So if a company have a right to appoint majority of the directors, then definitely they have a control of the other company, and accordingly it can be either through shareholding agreement or through some arrangements with the other company, whatever member. So to prepare the presentation of the consolidated financial statements, these are the key objectives as prescribed in the standard. So require entity, that is a parent, and one or more entity subsidiaries. So these two to be clubbed as a consolidated financial statements. Then we have to define the principle of control and establish a control basis of consideration that we will be discussing in detail, and sets how to apply the principle, what are the accounting requirements, and in case of innocent entity, that also I will define. In that case, there is exception in the consolidated financial statements. So except few exceptions, entity that is a parent, that is the company is holding more than 50% of shares in another entity, needs to prepare consolidated financial statements. So the standard does not deal about the business combination 103, that is including goodwill arising on a business combination. That separate standard is taking care. Whenever a company is acquiring shares of another company, this standard is not giving guidelines how to deal that in their financial statements. It talks only about consolidation procedures that will be accounted under IND AS 103 in the separate financial statements. So this standard does not apply to employee benefits, that is IND AS 19. So we will not cover those things. And in case of innocent entity, the company need not consolidate financial statements. What is innocent entity? The company is investing in another entity just merely for purpose of investing in another entity. So those companies need not prepare consolidated statements, but there is an exception that also I will explain in detail. So there are certain exceptions. This is one. If you fulfill all these conditions together, then there is no necessity to prepare a consolidated financial statements. The first condition is it is a wholly owned subsidiary or is partially owned subsidiary. Company A is the holding company. Company B is a subsidiary of A, either wholly owned or partly owned. That is different. And it has been informed to all the owners. So the company B has informed A and other shareholders of its company that they are not preparing the consolidated financial statements, and none of the shareholders are raising objection. That is the first condition. So it is its equity or debt is not listed in any of the stock exchanges. That is second condition. It is not in the process of filing any listing requirements. So that is the third condition. Fourth is the ultimate holding company is preparing consolidated financial statements. That is at India level. If the ultimate holding company is outside India, then this exception is not applicable. So the topmost layer of the company has to prepare a consolidated financial statement, and the next level holding company has to inform all its owners that they are not preparing consolidation because company A is going to prepare, and none of the owners raise an objection. Then and it's not listed either equity or debt, then they need not prepare a consolidation financial statement. In all other cases, it is mandatory to prepare consolidated financial statements. So this is the definition of consolidated financials, which I told. Control, I explained. Decision maker is the person whose decision is binding on the company. Group is nothing but a holding company and its subsidiaries, that is components. Parent is the entity, controls the entities. Subsidiaries, the companies act upon the decision of the other company. Innocent entity is an entity that obtained from one or more innocent. For example, PE funds, it's an innocent entity. If it is a company, it collects money from various stakeholders or providing investments to various others or providing management services. So that is first condition. And it comes to the investor that they will use that money for the business purpose and invest the funds fully for return purpose or capital appreciation. So the PE funds will collect money from various parties. I am giving PE fund as only an example, but a lot of companies will do investment as a main thing. But they collect money, they will use for business purposes and invest solely for return or capital appreciation or both. Then second condition, and they also measures, evaluates the performance of substantially all its investment on a fair value basis. That is most important. They have to always do the investment on a fair value. They have no option to account on a cost basis. If they comply with all these three, then it will be treated as investment company. Investment company need not prepare a consolidated financials except an exception. Non-controlling interest is nothing but a minority interest what we use in our Indian standard. That is, those who are not parents will be classified as non-controlling interest. This classification has a vital meaning because I may not hold any shares in the subsidiary, but still I have control. That we will be discussing in detail. Even then we need to consolidate the financials. I am not a owner, so I have to classify 100% share capital under non-controlling interest. That is hypothetical cases we need to justify, but that is the reason for using this term non-controlling interest instead of minority interest. Power is nothing but existing rights that give rise to the current ability to direct their relevant activities. This also will be having a detailed discussion subsequently. Productive rights, for example, banks would have taken the shares just as a security from the promoters, so they may have a protective right. They don't have a other rights. They will not interested in running the business. They are concerned about the amount lended by them. In that case, that is known as protective rights. Relevant activities, activity that may affect the day-to-day operation of the entity. That is the simple meaning. Removal rights, the power to remove the directors, power to remove the decision makers of the entity. This is the broad outline. Outright control. If the answer is yes, straight away go to consolidation. If the answer is no, then we have to see whether it's a joint control. Here again, if it's yes, then we will see what is the type of joint arrangement. We have to go to the standard 111. Now we are discussing about 110. We have to go to 111. Here, if it is joint operation or joint venture. So these are two different meaning. Joint operation means we are doing certain transaction together. Joint venture is a not common thing. Everybody will be doing a joint venture operations. When we go for a joint operation, we will follow the principles as in 111. Account for assets, liabilities, revenues and expenses, and follow the principles of 112. There also JV also the concept is same, but we will be going for equity accounting. That is the second one. if there is no joint control, then we have to see what is whether there is a significant influence. What is significant influence? More than holding more than 20% of the stake. If the answer is yes, again we have to go for accounting the assets, liabilities, etc. If it is not, then we have to go for financial accounting under 109. That is financial instrument standard. 107 is regarding the disclosure requirements as per IND AS. This is most important for this application of the standard control. First, the owner, that is the holding company, must have power over the investee. Second, ability to use its power over the investee to affect returns. Third is exposure or rights to variable returns from his involvement in the investee. So I must have the power to control the investee. I must have the ability to use the power over the investee to affect returns, that is to get the income, whatever may be profit or loss, whatever may be, and that return was the variable. So all these things are cumulative. For example, preference share capital, they will be getting only fixed dividend, so they don't have variable returns, so they are out of this purview. So control how to determine. Consideration following factors may assist in making the determination. The purpose and design of the investee, what purpose it has been created, what is the relevant activities are and how the decisions of those activities are made, whether the rights of the investor give the right current ability to direct the relevant activities. Fourth is whether the investor is exposed or has rights to variable returns from his involvement with the investee, whether the investor has the ability to use his power over the investee to affect the amount of investor return. So these are the broad principles given in the standard, but case to case it is not easy as we read in this standard. Practically, I will tell you a couple of examples in the end. It will be very difficult to define whether the entity has a control or not, merely because it is not as easy as that just I am holding 51%, whether I am a holding company, or merely because I am not holding the shares, whether I am not treated as a holding company. That is a judgment factor. We need to have a lot of research and discussions. Some cases, two or more investors collectively control investee, and when they must act together to direct the relevant activities. In that case, we have to see whose decisions are more vital in controlling the entity, then accordingly we will do. So each investor would account the interest in the investee in accordance with the relevant standard. So they may be a joint arrangements 111, it may be associates or joint venture 28, or it can be just investment per se, it is financial instruments. Power, as I told you, three things we need to see. Under control, power over the industry is the most thing. I must have existing rights that give current ability to direct the relevant activities. So existing rights, as on day I must have the ability to control. I am going to get the power after 3 years, no, as on this date when I evaluate whether I have the rights. So in some cases I may get the power by way of some arrangements with the owners, that can also we have to evaluate. So we must have the ability to direct the relevant activities, has power even if its rights to direct have to be exercised. Some cases I may have the power but I will not exercise that. In that case also I have to see whether I have that power which can be utilized as and when the owner insists. So if two or more investors each having the existing right that give them a unilateral ability to direct different relevant activities, the investor that who has the current ability has to treat it as a owner, that is a holding company. So that is the most thing. So even if the two persons have the ability and they have the right, then they have to do the testing as prescribed in the standard to decide who has the current right. Accordingly, that person will become the holding company and other person will be a co-owner. In IGAP, a subsidiary can be consolidated by two entities, but in IND AS that is not permitted, in IFRS is not permitted. We need to pass the test and decide who is the owner. So for the purpose of assessing the rights, only the substantive rights that are not protective rights to be considered. As I told you, the rights given to some lenders or rights given to some of the promoters, or if they have no substantive rights, then that should not be considered for assessing the rights. Returns. The very purpose of making investment is to use the funds in business perspective, and we must get return. The return has to be variable, it should not be fixed. It can be positive, it can be negative, or it's a combination of both. That is different, because while investing, the owners will not know when the company will make profit and what will be the profit, because it depends on the risk and rewards they are going to take. It may be high, it may be low, or some cases it may be fluctuating frequently. Although only one investor can control the industry, as I told you, even if there is 50-50 or 60-40, and the 40% may be a owner, but if more than one investor can control the industry, more than one party can share in the returns of the industry. For example, holders of non-controlling interest also get the return of the efforts put by the major shareholder. So variable return is returns that are not fixed and have potential vary of result of the performance of the investee. That is the most important thing. Returns can be positive, negative, or both. So agent is just a person who is acting on the directions of another person. So agent will not become a owner. So there is a direct link between the power and returns. An investor controls the investee if the investor not only power over the investee and exposure of the rights to variable returns from his involvement with the investee, but also an ability to use his power to affect the investor return from his involvement with the investee. So thus the investor with the decision making rights shall determine whether it is the principal or an agent. If he is the principal, definitely he has the control. If he is the agent, definitely he is not, because he has taken the power from somebody else. So relevant activities. So first is control, second is relevant activities. So we have power to appoint the board of members. Major capital expenditure, if a person takes able to decide on the major capital expenditure, putting up a plant, selling a plant, those things are treated as a relevant activities. Acquiring or disposing subsidiaries, so making investment in subsidiary or associate, that is the key decision making. It may affect the returns of the company. And approving budgets, because that is more critical for future income generation, so whether that is permitted. Dividend and remuneration decisions, so if a person is able to decide on the dividend policy or the remuneration policy of the employees, key employees, selling or buying goods and services to go into a new line of business, whether particular line of products can be sold or not, those things are treated as the key items. This is only indicative. So these, if you have an investor has these rights, then definitely he is having power to do the relevant activities. So control coupled with this, it will give more weightage. So this is in descriptive form of the same thing what I explained in the previous slide. So rights, power over industry is voting rights, potential voting rights. What is potential voting rights? Today I am a preference shareholder or a compulsory convertible debentures or an investor, but there is an agreement with the company that I have some right which can be exercised on certain events. Then that person has a potential voting rights, and I have a right to appoint the KMP or board of directors. Right to enter into or veto transactions. If the management does some transaction, if I have power to undo that or cancel that, then I have a right. Any other rights, business agreements, whatever may be. So as I told you earlier, an investor can have the power even if it holds less than the majority of the voting rights. Suppose I am holding only 40% or 20% stake in a company, but due to certain arrangements, I may have the control on what basis. Say contract arrangement between the investor and other voting holders. For example, the share is held by 4 or 5 groups, but only one group is actually taking control of the business. So to run the business without interruption, they may have an agreement with other stakeholders. In that case, there is a contractual arrangement. Rights arising from other contractual arrangements, as I told you, so some PE arrangements or whatever may be, they may some rights to conduct the business. Investors voting rights, their own holding, potential voting rights, as I told you in the previous thing, and any combination of this. If all these things put together, I have power, then I can have the ability to control the entity. So investor with less than the majority of the voting rights has rights that are sufficient to give it a power to over the investor. So accordingly, then I will be treated as a owner. Control, if so, is to be consolidated. So the enterprise may control the composition of the governing bodies of the entities such as gratuity trust, provident fund, etc. because it is created by us. So whether we need to consolidate their accounts. No. On what basis? Why? Huh? So variable return one thing, sir, because here is only outgo, there is no return at all. The thing is, it is not for business purpose. So it is just to comply with certain statutory requirements. We are as an employee cost, we are having separate trust. So to administration only we are controlling. We are not going to get any variable return. That is the first thing, it fails. So anything PF, gratuity trust, etc., in large corporates or banks you would have seen, there will be separate trust managed by themselves. The treasury department will take care of the investments, the CFO will be preparing the financials. So everything will be under their control. All the decisions, all the trustees will be their own employees or the key people. But instead of that, it will not be consolidated because that is not for any business purposes or there is no return. So a parent shall prepare consolidated financial statement using uniform accounting policies for light transaction and other events in similar circumstances. This is most important thing. Under IGAP, there is certain exceptions saying that if it is practically not possible, then we can go with the different accounting policy. But IND AS or IFRS doesn't allow that. If one of the component, that is it can be subsidiary, associate, JV, whatever may be, they must follow the same accounting policies. If not, you have to do a memorandum adjustments. You can't ask that company to redo the accounts. That is audited. So, but as a joint auditor, group auditor, we need to get this accounts adjusted. That is known as memorandum changes. We need to have that effect of those standards or policies which are not inconsistent with the holding company. Then we have to do the necessary correction in the consolidated financials. This is the most important thing. There is no exception under IND AS. So, consolidation of the university shall begin from the date of control till the date it exists. So, if it, for example, 1/4/24 to 2025, if the company takes control on 1st July, 9 months financials must be included in these books. Similarly, if it lose the control on 31st December, till 9 months. So, even then you have to prepare a balance sheet on a consolidated basis on 31/3/2025. Because the control is not there on 31/3, we should not say that I will not prepare consolidated financials. We need to prepare consolidated financials till the date we have that control. Non-controlling interest is nothing but different same meaning as minority interest. But here, as I told you, even 100% shareholder, the owner may be a non-controlling person because he is not doing the day-to-day operation of the company. He doesn't have the control. So, in the group it can come. They will not hold any shares, but merely because of their taking care of the entire business operation, they may consolidate the results in their books, but the entire 100% profit will be grouped under non-controlling interest. Then you can think what is the purpose of doing this, because as per the agreement they may be getting some shares because that is more critical for some of the components. So, this operations is more critical for generating income or for providing some services to the subsidiaries or some other associates. So, definitely they will not hold the company, but they will control that company to take care of that group perspective. This is most important thing. This is quietly different from our Indian perspective. Changes in the parent ownership interest in a subsidiary that do not result in parent losing control of subsidiary or equity transactions. What is this? I am holding 80% shares in a subsidiary. I am selling 5% stake. Normally what will happen? I acquired for 1 crore that 80% stake. 5% I am making a profit of say 10 lakhs after 1 or 2 years. Normally what will happen? In the standalone financials, we will take this 5 lakhs to our P&L as a profit on sale of investments. Simple. When you come to consolidation, this will not go to your P&L. It will be eliminated, it will go to reserve because that is a transaction between owner and owner. Till such time you lose your status as a parent, you have to do all the transaction between the stakeholders only under equity. It should not touch your P&L. This is the most important thing. Most of the companies will not agree because it will affect their EPS. For example, in the standalone they will have shown, assuming that there is no other transaction, the standalone will have a huge profit on sale of subsidiary. When you come to consolidation, the profit of consolidated financials will be much lower than the standalone profit and loss. So, the CFOs will not agree, CFOs may agree, but the management will not agree because they want to show a better EPS under consolidated perspective, but standard prohibits. We need to be extra cautious. Lot of mistakes will happen in this area because we will presume that yes, it is a realized profit, there is nothing wrong, but the standard is not perfect unless there is a loss in the status of parent, you lose control, you need to move this profit or loss only through equity, not through P&L. So, when we loss of control, if a parent lost control of subsidiary, it may happen. I am holding 60%. I have sold around 40%. Now it is less than 20%. I am not even associate, or it can be even so, assuming that I have sold 40%. I am just associate control. Then what I do? I have to remove from the consolidation process. So I have to derecognize the assets and liabilities of the subsidiary from my consolidated financials. That is the first thing. recognize any investment retained. I am holding 20% stake, whatever may be, at its fair value when the control is start. So I have to evaluate what is the fair value and accordingly retain that as a investment. Either I have to see whether it's associate or as a simple investment per se. And accordingly I have to follow the principles of IND AS 109. Now I can recognize the gain or loss associated with the loss of control attributable to former controlling interest. Now only I can recognize interest. If I don't lose the status of parent, I have no right to take to P&L. If I lose the status, I can take it to P&L. This is a broad summary what we discussed till now. Consolidation procedures is simple. We have to do a line by line addition. All revenue items, all expenditure, as the cases we have to add, and we have to similarly balance sheet also to be aggregated as it is. Next step is intercompany elimination. This is most important thing. If all the components have a same year end, there is no issue. But if we have different year end, because IND AS permits 3 months gap, IGAP permits 6 months gap. But IND AS, if we say there is a gap of 3 months, then what we will do? I have sold one item to a component, it has not received at that end. If it had it happened, it's same accounting year, they would also accounted the purchases, I would have accounted sales, I can eliminate easily, only the profit will be eliminated. But in this case, it's not happened. Then also we have to do the memorandum adjustments and see to reflect the correct profit or correct transaction. And similarly, translation of foreign operations. Errors will happen only in these two areas. First line is simple mathematics, so any Excel sheet will do. These two we need to be extra cautious whether we have done the consolidation process correctly. Uniform accounting policies, as I told you, there is no exception. We have to mandatorily follow the same accounting policies. If it is not done by any of the components, then we need to do the adjustment at consolidated level. But most of the auditors will seek the details from the component auditors because it is difficult for them to do at the holding company level. So they will give the details to them and they will ask them to give the workings for the adjustments. Profit loss allocation. So we have to allocate the profit between controlling and non-controlling. Controlling is nothing but owners, non-controlling is other than owners. So based on that actual share. Here only the shareholding percentage is coming to picture. Till now we are talking about the control. Only for allocation of profit we will see the basis of ownership. If the 100% is non-controlling, then we will move entire profit to the non-controlling. So non-controlling is shown as separate line item under equity itself. Here compared to the IGAP, in IGAP we will account the losses till the investment becomes zero. Here it can be negative. So because they are also owners, irrespective of that percentage plus or minus, we have to allocate the losses to non-controlling interest. So you can see in the balance sheet it can be a negative figure under equity. Loss of control, so gain or loss arising on loss of control, it can be taken to P&L. If it is no loss of control, any gain or loss on sale of transaction has to be grouped only under equity. It is transaction within owners. Hope this is clear. Any clarification required in this, please let me know. So as I told you, we need to be extra careful in that loss of control, that when there is no loss of control because the mistakes will happen. And here is elimination of intercompany. Barring that, other things are all quite common. Can I move it? Can I proceed? This is a descriptive of what I have shown in the previous slide. This is most important thing. So group uses accounting policies other than those adopted in the consolidated financial statements for the late transaction and events in similar circumstances. So this is the most important thing, late transactions. If it is they are using a different transaction, I am doing some business, subsidiary is doing some other business, they have their own accounting policy, no issues. But the same transaction, if this company is also engaged in consumer durables, subsidiary also handling the same item, we can't have a different policy. And similar circumstances. So geographies, some geographies may permit certain things. We have any exception, that is not a problem. Otherwise, we need to do necessary adjustments in the consolidated financials to align with the holding company's accounting policy. Now with this SA 600, the new ISA 600 become mandatory from next year. Lot of happenings are happening. Even most of the firms are started doing from this year itself. So here this issue, the responsibility on the component auditors has increased substantially. So we need to give a lot of information to the holding company auditor. Till last year they used to rely on just the balance sheet signed by us, but this time they are asking for various details for various components, because whatever they identified as the key items, they will ask for a lot of details. They will review our working papers. So we need to be extra, whenever we are doing a component audit of a company for which the holding company is a different auditor, we need to have all the documents ready, because they have to check that before they sign off their financials. So as I told you earlier, the entity includes income and expenditure of subsidiary in the consolidated financial statement from the date it gains control till the date when it ceases its control. So from the date of acquisition to the date of cessation, they have to recognize the transactions of the subsidiary in these books as a consolidated financials. So income and expense of the subsidiary are based on the amounts of the assets and liabilities recognized on the consolidated financials on the acquisition date. This is the most important thing. See, normally what will happen, if the company is floated fresh, there is no issue, because it will be at cost, we will know. But if you are going to take a acquisition at a later date, we are going to purchase, then the fair value comes into picture. Only area that will affect is your fixed assets, because other things we would have, other standards will take care of that. It will be at record, fixed assets is always recorded at historical cost. They would have provided depreciation based on the useful life. But if the holding company, that is the parent, is going to acquire the stake of the component at a later date after 5 or 6 years, the value would have increased or decreased. So then we need to do a fair valuation. So here the memorandum of adjustment will come, because the component auditor will prepare the financials based on their books of the previous year. But for consolidation purposes, we need to account basis the fair value on the date of acquisition. So there will be a memorandum of adjustment. This is one cumbersome process. We need to have two depreciation statements for each and every component whenever there is a acquisition. So most of the companies, what they will do, they will also do a revaluation under the component level on the date of acquisition, so that it will facilitate ease of booking the income and expenditure at the holding company level. So this is the one I told you, depreciation. So in consolidated financial, entity shall attribute the profit or loss and each component of other components to the owners of the parent and non-controlling interest. This is most important thing. So both your profit for the year as well as the OCA has to be allocated to both. So negative I already told you. And if a subsidiary has a outstanding cumulative preference shares, not at holding company level, I am talking about subsidiary level, that are classified as equity for the purpose of consolidation. So because as per Ind AS, as you know, if there is a compulsory convertible preference shares or compulsory converted debentures, we will be treating a portion of that as a equity, because that will be converted into equity at a later date. So we will assign a value for capital, we will assign a value for liability. If that is so in the subsidiary level, then while doing this allocation of share of profit or loss, we need to give effect to the dividends on preference shares, even if they are not paid the dividend. That is the most important thing. We will miss most of the cases, because we will get the balance sheet only at the last date. We will just do the consolidation. Whenever there is a preference shares issued by a component, that is your subsidiary or associate, we need to ensure that whether they have paid the dividend. If not, you have to do the adjustment, because that portion has to go to non-controlling interest, not to your profit. This is the investment entity I told you in the first slide. A parent shall determine whether it is an investment entity. So what is investment entity? It is obtained from one or more investors for purpose of providing those investors with investment management services. So portfolio management services, investment management services, I am collecting from so many people. Commits to the investor the business purpose of the investor solely for generating income or capital appreciation. So they will give a declaration saying that after 5 years this value will become this, or I will get a minimum return of 20% per annum, whatever may be, or a combination of both. I will give both return as well as appreciation. They will measure and evaluate all the investments at fair value basis. So because it fluctuates, so they can't say that I will go with the cost basis, I will revalue on a yearly basis and account always on a fair value basis. If fulfill all these three conditions, that entity will be treated as an investment entity. If it is investment entity, it has to be more than one investment. I can't say that I have just collected from 5-6 people and invested in only one subsidiary. Then it's not investment entity, because that risk and rewards are linked to only one particular investment. Then it will not categorize as investment entity. It has to be more than one investors. I can't get the entire from one company and give it to so many investors. That is also not an investment entity. So you have to fulfill both these conditions. I have to collect from so many people, I have to invest in so many projects. And it has investors that are not related parties of the entity. I can't collect from my group companies and say that I am an investment entity. That is not permitted. So it has ownership interest in the form of equity or similar interest. So in India, we are always talking about equity, but if you go to the other countries, there are different way of getting finance. That's the reason all IFRS and IND AS use the words any other interest. So any absence of any typical characteristics that not deny from being classified as investment entity. So they need to give additional disclosure. If it is investment entity, they have to give disclosure under IND AS 112, disclosure of interest in other entities. Suppose for an example, investment entity as a subsidiary which is doing support services, for example HR services is handled by them, or some back office work is done by them. In that case, that is ancillary to the investment entity. In that case, they have to consolidate that subsidiary alone with this balance sheet and give a consolidated financials. So a parent of investment entity shall consolidate all entities that controls, including this investment entity. Suppose it's a holding company, the second subsidiary is a investment company, and they have another company that is consolidated. But if a parent is not an investment company, then they have to consolidate all these components, including a investment entity, if it is a subsidiary. This is seen. So here the date of change. Investment entity can become a main entity or vice versa. A parent can become an investment entity also later date. The fair value of the subsidiary at the deemed acquisition date shall represent the transferred deemed consideration when measuring any goodwill or gain. All subsidiaries shall be consolidated from the date of change of status. So once it loses the investment entity status on a particular date, merely because the owners have been consolidated, now it has become one owner, or I am not invested in so many projects, only one single investment. In that case, it loses the status of investment entity. In that case, I need to undo the investment entity accounting. That, in other words, I have to do the consolidation. So I have to do the consolidation of all subsidiaries from the date of change of status. So similarly, when an entity becomes an investment entity, it shall cease to consolidate. Till date I am consolidating, but this year when I am evaluating, I am finding this entity is an investment entity. Then I have to undo this consolidation. On the date, the value whatever is shown in the books will be treated as the fair value. Key differences between IND AS and AS. AS 21 is on consolidated financials and IND AS 110 is what we are discussing. Here it is mandatory to prepare consolidated financial statements, except limited exceptions. I told you only for investment entities. CFS IGAP does not mandate preparation of consolidated financial statement, but now with the provisions of Companies Act, there also it became mandatory to prepare consolidated financial statements. The division of control is principle based, so it is not rule based; it is principle based. So we need to test whether we have the control or not. Variable return of income, whether the rates, everything has to be tested and documented. Accordingly, we have to decide whether we have a control on another entity. There, it is purely on ownership. If I hold more than 51%, simply I am a owner. So I have to do the consolidation. There, this rights and all is not having no use. IGAP will not look into all those aspects, but in IND AS we have to see the control per se. 110 defines control. If there is a conflict, we need to test and prove who owns the entity. That is mandatory. So consolidation can happen only with one entity, not with multiple entities. But IGAP it is possible. It can happen with multiple people also. Hypothetical, but it happens. So IND AS 10 does not permit exclusion of subsidiary from consolidation when control is intended to be temporary. In IGAP, when I am acquiring a subsidiary with the intention to sell immediately just to gain some profit, or if it is for some other reason, or it is under severe financial recession country, then we are permitted not to consolidate and show some other results. But in IND AS that is not permitted. We have to do mandatory consolidation. So difference, as I told you earlier, the gap should not be more than 3 months. The parent company and subsidiary company, that is component. If it is 31st March, it can be maximum 31st December, not prior to that. But in IGAP, we have a time gap of 6 months. So up to September results, we can consolidate in March financials. So whenever there is a change in ownership or there is a change of control, Standard gives a lot of guidance how to account it. As I told you, the profit has to go to the UVT only, or how to take it to P&L and all. When the IGAP, there is no such guidance. We have to follow the convention what we followed till date. So both the AS 21-110 requires the use of uniform accounting policies. That is the first line. But there is exception where it is practically not possible. We can give it a disclosure in the note that we can follow different accounting policy, but in IND AS it's not permitted. Potential voting rights also to be considered for IND AS, but there is no concept of potential voting rights in IGAP. So we will go with the actual voting rights. Deferred taxes is one of the key thing. There may be mistakes. Whenever we do some consolidated elimination, we have to give effect to the deferred tax in consolidated financials under IND AS. IGAP we will not do that. We will just add all the things and remove the intra-group company transactions. That is all. Deferred tax as it is in the components will be aggregated and shown in the deferred tax liability or assets as well as in P&L. But in IND AS, whenever you are removing some profit or removing some transaction from the consolidation, you have to see what is the impact of deferred tax. Had this amount is not accounted in the components, accordingly we have to undo that also. This is the most important thing. There may be mistakes in this. Regulators now pointing out this aspect. So one of the most important things for both IFRS 10, this is between IND AS and IFRS. So both go with the fair value concept. Exception is in IND AS, we are asked to do valuation of investment property only at cost basis. We have to give the fair value as a note only. But IFRS mandates we have to treat investment property also at fair value. That is one major change. So consequent to that, they have removed one para which is available in IFRS in IND AS. Barring that, there is no difference between IND AS and IFRS. There are certain differences between IFRS, IND AS and IGAP, but not as far as IFRS 10 and IND AS 110, only exception is investment property. Other than everything is same. So some FAQs, I will come to this after completing the other two topics. With this, we have completed consolidated financials. If you want any further clarification on this, I will be happy to answer. NC is not fair value reserve because you have to have the policy how you are going to account your components. See, for example, if you are having a subsidiary, you will be doing a line by line additions. You can't do the changes. Only whatever acquisition will be totally different. See, when you are taking control of a subsidiary, on the date you will do the fair valuation. Accordingly, you will accounting the goodwill or capital reserve in the standalone financials. When you come to the consolidated financials, you will be providing depreciation and other adjustments based on the fair valuation on the date of acquisition. Accordingly, you do the transaction. Profit per se, it's for the year. You will do elimination for the intra-company transactions and the year-end profit only retained. Whatever shown in the P&L will be allocated based on the percentage of holding. That is all. Any questions? Shall I proceed? Separate financial statements 27 and 28 is on investment associate and joint ventures. In India, we will give most important to separate financial statements. Even in IND AS, even for listed companies, our most attention will go only to the separate financial statements. Consolidation will come at the last end. But that should not be the case. We have to give most importance to consolidated because separate is only as a addendum. But companies that give more power to separate financial statement because there it is mandatory to prepare separate financial statement, and in addition to that we are preparing consolidation. So in India perspective, separate financial statement is more important, and we have to ensure that we complete these standards. In other countries, as I told you in the first slide, it is optional to prepare separate financial statement. Now here it is not the case, it is mandatory to prepare separate financial statement. We use the word standalone here in India for separate financial statement. And that word we will use only if you have a consolidated financials we are going to prepare, then only we will use the word standalone, otherwise we will not use it. Normally it is known as financial statements. If it is financial statements, always it is by default is consolidated under IFRS. In India, by default it is standalone. If you have components and you are going to prepare consolidation, then only you have to use the word standalone financials, otherwise it will be financial statements per se. Here also I am going to touch upon the standards requirements, objective and scope, key definitions, preparation, disclosure. and has come to differences and ITFE calculation FAQs. The standard prescribes how to account the subsidiaries, investment, joint venture associates in the separate financial statements of the company. Here standard says it does not mandate which entities produce separate financial statements, but companies that override this and we have to prepare a separate financial statements. This we already seen what is consolidated, what is separate. So here standard says separate financial statements are those presented in addition to consolidated financial statements, in addition to the financial statements in which investment associate joint venture are accounted for using equity method other than following circumstances. So an entity may present separate financial statements as if only financial statements if again the same exceptions. When if you are not going to prepare consolidation financial statements because of the exception I told you that the holding company is going to prepare consolidation, I am not going to prepare consolidated financial and I am not a listed company, I am not in the process of listing, etc., then this will become the only financial statements. The same condition is repeated in this standard also. So when entity prepares a separate financial statements, it shall account for investment in subsidiaries, joint ventures, associates either at cost or in accordance with IND AS 109, that is financial instruments. So we have option here. Most of the 99% of the companies will go for cost basis because that is easy to comply with. Otherwise the valuation will be very cumbersome. So for separate financial statements, they will go always with the cost model instead of fair valuation model. Here also we have to ensure that the same accounting policy is followed. That is most important thing. Unless it is held for sale, then we have to follow the principles of 109 and 105. The cost option is not available in case of following situations. So if it is held through indirectly or directly through venture capital organization, mutual fund, unit trust, so their intention not to hold for long term and run the business, mainly for profit or capital appreciation, then you can't follow cost model. You have to mandatorily go for financial 109, that is fair value model. So similarly, if the parent is required to measure its investment in a subsidiary at a fair value due to requirements of other accounting standards, then also they are not permitted to follow cost model in the standalone financial statements. What will happen when entity ceases to be investment entity? We already discussed the same concept what we discussed in the consolidated financials applicable here also. So we have to account the investment in the subsidiary at cost, and similarly the fair value of the subsidiary at the date of change status will be used as a deemed cost on the date. It has to be accounted as a subsidiary in accordance with IND AS 109. When a parent becomes investment entity, again the same concept. So it shall account the investment in the subsidiary at fair value through P&L in accordance with 109. Difference between the previous carrying amount of subsidiary and its fair value at the date of change, it will be recognized in the gain of profit or loss. Cumulative amount is fair value previously recognized in the other companies to be moved to the P&L. Dividend from subsidiary, joint venture, associate to be recognized only when the right to receive the dividend is recognized. Most of you would have seen previously we used to show provision for dividend in the balance sheets. Now after that amendment we are not showing that. We are showing as a footnote in the share capital that the company declared dividend so and so if it is declared in the board meeting while adopting the accounts. Otherwise that will also not come. It will come as an appropriation item under retained earnings whenever the dividend is declared and paid. So that is the status we are following. Prior to that we used to make a provision for that. When we do other end, when we prepare a separate financial statements, even if you have not received the dividend, if I have a right to receive the dividend that is declared by that company at the AGM, but our balance sheet debt closure is subsequently, but we have not received, then also we have to recognize the dividend. This is more of matching concept, then only the elimination will happen smoothly. So when there is a reorganization in the group, so when a group, a new entity is being created, so that becomes a parent. What is accounting treatment? So new parent obtains control of the original parent, that is company A is holding now. Above that, now company X is being formed that acquires the stake of this company, then that will become parent. Then what will happen? So they have to issue equity instrument to the original parent. They can issue the shares. Assets and liabilities of the new group and the original group are the same immediately before the date of the reorganization, and the owners of the original parent before the reorganization have the same absolute relative interest. So it is just a reorganization within the group. this company will go to the one level up. In such cases, the new parent accounts for investment in the original parent at its cost in the separate financial statements. Further, the new parent shall measure the cost at the carrying amount of share at the equity item shown in separate financial statements of the original parent at the date of the reorganization. So this is most important. It may undergo change because when you go for a separate financial statement, originally I would have accounted at certain cost. Now on the date of change, the value would have changed. So we need to re-establish that. Similarly, an entity that is not a parent might establish a new entity as its parent in the manner that satisfies the above mentioned criteria. Same principle to be applied in the separate financial statement, but not much change will happen in the consolidated level. So here the disclosure is, detailed disclosure is given in the standard. In addition to that, there is disclosure command under Schedule 3 also. We need to ensure that we are compliant with the disclosure requirements as given in 112 as well as Schedule 3. Lot of regulatory findings happening only in this disclosure part because they can't check whether we are compliant with the standard correctly or not on reading the financial statements because that is most of mathematical assumptions or judgments. But disclosure of standard requirement, disclosure as required the numerical and the AS 112 and Schedule 3, there may be gaps. If you miss this, the regulator will find fault on the auditors. All these things we will give as a part of our related party disclosure. So name of the university is principal business. This will miss the principal place of the business, country of incorporation, different, etc. We have to give a table and give all this information in the consolidated financials and also in standard financials. And description of the method used to account the investment. Even recently, NEFRA has pointed out the company has not mentioned whether they are accounting the investments in components, whether at fair value or at cost. Simple thing, they have not disclosed that fact. Huge penalty. This is regarding ITFG calculation. These most important things. Whenever you do IND AS financials, please go through the ITFG clarifications because very detailed and it will clarify a lot of practical issues. Company has equity investment in a limited liability partnership. A company has a joint control over LLP. Whether that need to disclose that whether profit from LLP to be adjusted carrying amount of the investment in LLP. That is one of the questions. Because the standard says it's the body corporate. And it says in separate financial joint operator or joint venture shall account interest in joint operation, joint venture. And further, IND AS 27 says investment subsidiary joint venture shall be either at cost or in accordance with 109. So accordingly, they said. So the accounting treatment of return of investment, that is profit share of LLP, will depend on the terms of contract between company and LLP. The share of profit in LLP shall be recognized as income in the statement of P&L as and when the right to receive its profit share is established. So you normally what will happen? If it is a partnership firm, whenever the profit is in, that is credited to partner's current account. But LLP is a different entity per se, only if they have the right. So normally nowadays they are putting a clause in that agreement so that then only they can take the profit. Otherwise, whenever the profit is transferred, only we can take the P&L. So to avoid that, they are classifying that. But the standard says only the right to receive the profit is established. Then only we can recognize the profit in the separate financial statements. Company has made investment in subsidiaries. Company elects to measure the investment in S Limited fair value on the date of transaction as per 109. Can company A opt to carry the investment S Limited cost after the date of transition? This transition date now, this has no relevance. So we have an option to choose the deemed cost or previous gap value, what it may be. As a first time adopter, we have option to take the fair value and substitute as a deemed cost. So in accordance with though, it may note that the first time adopter cost of investment in a subsidiary shall be one of the following amounts: cost determined in accordance with 127, retrospective application of 27, fair value of the entity on the date of transition, previous gap carrying amount. We can adopt anything of these three. So accordingly, in this case, we can continue. Fair value is deemed to be the cost of 107. Accordingly, we can continue the same value at cost. IAS 27, IND AS 27. So disclosure, we need to disclose the reason for preparing separate financial statement if not required by law. In India, it is mandatory. So since companies had mandatory preparation of separate financial statements, such requirement has been removed in IND AS 27. But there we need to give a note why we are preparing separate financial statements. IAS 27 allows the entities to use equity method to account for investments in subsidiaries, joint ventures and associates in their separate financial statements. Here, option is not given in 27. the equity method is not a measurement basis like cost, because in consolidation only we will have the equity method concept. Standalone we will not go by that. So that para is removed. This is with regarding to 27 separate financial statements. Any queries? This 28, the standard talks about associate and joint ventures. Consolidation is about subsidiaries. Now we are coming to the standard which talks about associate and joint ventures. Here also the same concepts: objective, key requirements, significant influence. That is more important. We will discuss that in detail. Application of equity method, that we are used to that. Classification of held for sale. Discontinuing to use the equity method. Impairment losses, FAQs. So this is standard is for the purpose of accounting the investment in associates and whether it's equity method, and how to account the investment in associates and JVs. So it scope is applied to all entities that have joint control or significant influence. They use the word joint control or significant influence because once it's have a significant influence, it will be treated as an associate. So significant influence is that the power to participate in the financial and operating policy decisions of the investee, but not control. Once I establish its control, I will go to consolidation. 110 will come into picture. I may hold 20%, but I have control, then I will go there. I have 80%, but I have only significant influence, I will come in this standard. So this is more important as far as this India is concerned. If it is joint control, I will go to some other standard. So when an entity holds directly or indirectly, that is through subsidiaries, 20% or more of the voting power of the investee, it is presumed that the entity has significant influence. So that is a basic presumption. I hold 20% or more, then I can say that I have significant influence of the entity. However, I can demonstrate, no, I am holding 21%, I am not having significant influence. They have document that to avoid this consolidation. Conversely, entity hold directly less than 20%, but even then I can say that I have significant influence. That has to be documented. Based on this conclusion, we have to see whether the standard applies to you or not. So the existence of significant influence is mostly evidenced in one of the following ways. Representation of the board. I am giving 20% stake in the company, then they will give one board seat. Total directors is 5, they will give one board seat. That is one basis. Participation in the policy making process, including participation in decisions about dividends or other distributions. I am just participating, I am not deciding. Once I decide, I will go to 110. Here I am just giving my suggestions, I am just participating. Material transaction between the entity and its investee. Obviously will happen because once I am going to give 20% stake in another entity, there will be some vested interest for business reasons. Interchange of managerial personnel. Mainly will happen in group companies. They will transfer the employees from one entity to other. Professional or essential technical information. Mainly for that also. That company may have a know-how. So to use that, they may invest some amount. If anything, these are the key areas basis which you can decide whether the entity is having significant influence or not. So the existence and effect of potential voting rights that are currently accessible and convertible. As in the case of 110, here also we can say you can consider the potential voting rights. So when the entity loses the significant influence over the investee, when it loses the power to participate in the financial statements, etc., it could occur, for example, the associate becomes subject to the control of government, court, administrator, regulator. It could occur as a result of contract arrangements. I am holding 20%, but due to some contract I have given the power to somebody else, I may lose the status. Entity with joint control of or significant influence. Even if I have a joint control, 50-50 stake or 40-60 stake, whatever may be, it is joint control. Significant influence more than 20%, I have the power. Then we have to follow the equity method of accounting, except when it is investment qualified for exemption. So that is a fundamental thing. When this is applicable, if I am holding more than 20% stake, I have to go for equity accounting. I can't go do a line by line consolidation. So what is the basic principle? What is the equity method? On initial recognition at cost, whenever I am making investment, say for example 100 rupees share capital at face value 100 rupees, but I am going to pay 200 rupees, that is my cost, first account at cost. because that is your fair value, because after doing some evaluation or valuation due diligence, you are going to invest that amount in the company for taking 20% stake. That is your cost. The carrying value of the investment is increased or decreased to recognize investor share in profit or loss. Every year there will be a profit or loss. You are entitled to 20% stake that you take it to your P&L, credit or debit. So investor's share of investee profit or loss recognized in the P&L of the investor. So we can take it to P&L, I already told you. Distribution received from the industry is reduced from the investment. I am taking the profit as and when it's earned. But whenever they are making the payment to me, my cash balance will go up and this value will come down, because from investment it will go to my cash and bank balances. So that adjustment has to be done. It is not a P&L item. Dividend receipt is not a P&L item. It is a balance sheet item. Other adjustment due to proportion change in investments, other comprehensive income. It can happen because I am holding 20% stake. There will be some changes in the other comprehensive of the component. That adjustment to be given. When potential voting rights exist, only the current ownership interest is considered and not the potential voting rights. I am having a significant influence because of my potential voting rights. So I have to take only what is the ownership I have by way of absolute ownership. That will only come. It can be 0, it can be 10%, it can be 19%, not the right I have the other entity. So what is the procedure for equity accounting? So the group share in the associate or JV is the aggregate of the holdings in the associate or JV by the parent and subsidiaries. So I am talking from group perspective, not from the standalone perspective, because standalone this concept is not there in India. So I am talking about consolidated financial statements. We have consolidated the subsidiaries line by line, that is over. Now we are coming to associate and joint venture. There we have to see the aggregate of holdings, because the parent may have the 3-4 subsidiaries. 3-4 subsidiaries may have 10%, 7%, 8% like that. Aggregate may be more than 20%. So we have to see the percentage more than that we have to account, because in that subsidiary books it would have been treated as investments only, not as associate accounting, because they were holding only 8% stake or 9% stake. So they will follow only simple accounting at cost. But at consolidated level, the threshold would have crossed 20%. So I have to do equity accounting. At consolidated level, if the threshold cross 50%, then I have to see whether I have to account as a subsidiary. That also we have to see at holding company level, not at component level. So the holding of the group, other associates or JVs are ignored for this purpose. So some cases, subsidiaries may have some other associates or joint purpose. That will not be considered, because I am seeing only from my parent I. Uniform accounting policy is mandatory. There is no unless in case of associate, it is imperative to do so. Only for IGAP in India they are giving exemption, because in IFRS that is not there. But here in India, associate, because getting a balance sheet of subsidy is easy, but for associate, since you are holding 20% stake, it sometimes may be difficult. They are giving a exception. If it is imperatively difficult, then you can give some disclosure and give a note. In case of inconsistency, you have to do the adjustment, as in the case of consolidation. Most recently available financial to be used. So gap permitted 3 months. So more than that is not permitted. So investment accounted are using equity method from the date in which becomes associate JV, same concept as in consolidation. Acquisition the difference between the cost and the fair value of individual assets and liabilities to be accounted as follows: goodwill or your capital reserve, same concept. Exemption also same as in 110, no something specific. When we are having some investments as held for sale, what will happen? Obviously, you have to follow the principles of 105, that what is the realistic value, we have to account that. Cost of which is lower, we have to make the provision. Any retained portion that is not classified as held for sale shall be accounted using equity method until disposal, or it can go to the simple per se investment also. Whenever the investment takes place, the retained interest in the associate or joint venture shall be accounted in accordance with 109. Unless the retained interest is still continue to be 20%. I am holding 35% or 40%, and after selling, I still hold 20%, then I can continue with associate accounting. Otherwise, I have to move to the this category. So when an investment or a portion of investment previously classified as held for sale no longer meets the criteria. I have certain parameters we decided is held for sale in the balance sheet and classified accordingly. Subsequently, the decision has been undone by the management and they are not going to sell that asset. In this case, I have to go back to the equity method with retrospective effect. Had I continued equity that day, because I have done the fair valuation on the date of selling, I have done some adjustments. I have to undo all those transactions and reclassify that to the original basis. So that adjustment has to happen on a retrospective basis, not on a prospective basis. That is the most important thing. So accordingly, financial statements for the period since classification as held for sale shall be amended accordingly. We have to give the comparatives also, we have to change, because if we do the adjustment in the current year, it will be misleading for the readers. So we have to redo the corrections in the previous financials. So entity shall discontinue use of equity method from the date when the investment ceases to be an associate or JV. So when it becomes a subsidiary, so we will go for consolidation procedures. When the retained interest in the former associate JV is a financial assets, so it will come down to threshold. So we are going to financial assets. Then the equity discontinues the equity method. So in any of these cases, we will be ceased to be a equity method. So when an associate becomes JV or a JV becomes associate, entity shall continue to adopt the equity method and no change is required, because concept is same, only this method of accounting is different. So whenever there is a change in ownership interest, so whenever the associate interest but the entity continues to apply the equity method, it has just reclassify the profit loss previously taken to OC to the P&L and vice versa. Impairment loss. So whenever you are accounting the equity method, the associates, the entity applies the principle of IND AS 109. Financial statement to determine whether the necessity to recognize any additional impairment loss, because we will be carrying at cost, for example, but we need to test for impairment. The associate is continuously making losses. We need to evaluate whether there is any further impairment loss to be accounted. So this is, as I told you earlier, in the separate financial statements of that company, we have to follow either cost or IND AS 109 as far as the investment in associate or JVs. So no disclosures are associated in the standard in the standard. 102 disclosure of interest other entity deals with the disclosure requirements. So we have to see whenever you are doing a consultation, you have to see all these related standards thoroughly, and in addition to Schedule 3, because we have to ensure that all the disclosures as per the standards have been taken care of. The difference between the standards, IAS 28, that is IFRS, requires for the purpose of applying equity method of accounting, uniform accounting policy should be followed, mandatory there. But here, unless it is impractical, is added. So only leeway is given in IND AS, not in IFRS. So IND AS 28 requires the excess of the investor share on the net fair value is investment over the cost of investment in profit and loss. But in GAAP, we are conservative. We will take it only to capital reserve, not to P&L. In IND AS 28 and AS 23, so significant influence, power of etc. more or less same. So in equity percentage voting, we will check only the actual voting rate, not the potential equity shares. That is one change between the IND AS and the IGAP. This also I told you, companies had no overrides, so there is no option. We have to do a consultation even if we have only associates or JVs. This is also not wrong. So IND AS 28 now permits an entity that an investment in associate, a portion of which is held directly through a venture capital organization or a mutual fund, unit trust, etc., to elect a measure that portion of the investment to either to P&L in accordance with 109, regardless of whether that entity has significant influence over that portion of the investment. So this one leverage is given in IND AS that we can exercise. Similarly, requires a portion of the investment in associate JV to be classified as for sale. The disposal of that portion of the interest would fulfill the criteria to be classified as for sale according to 105. AS 23 does not physically deal with this aspect, because AS 23 doesn't talk about assets held for sale, but in IND AS that is more important thing. And how to recognize that I explained in the previous slide itself. So in AS 23, in separate financial statement, we are not accounting under equity method. We simply follow the cost model, and or we'll make a diminution provision wherever required. But in AS, they seem to be accounted as cost in accordance with 109 financial instruments. So AS 23 permits the use of financial statements associated drawn up to the date of different from the date of financial statements. They have not specified any date, but here it's mentioned about 3 months. IGAP permits only to reduce the losses till the investment value becomes zero, but in IFRS or IND AS we can have a negative balance also. That is all from this slide. Can I take 10 minutes extra? I'll just go through that FAQs also. So IND AS 110, consolidated financial statements, as well as Companies Act require the companies to present consolidated financial statements. However, under both the regulation, criteria for determining the relationship with other entities are different. Standard says different wording, companies has different things, what to do, whether which one we have to follow, whether you have to follow the principles as per the standard or as per the Companies Act. Now we are given a clarification. Since the Companies Act says that we have to follow the accounting standards, that takes the precedence. So accordingly, we have to follow the principles as required under IND AS 110 whenever there is a conflict. Whether company H Limited is required to consolidate its subsidiary, which is limited liability partnership, this I already answered another thing. Definitely you have to do. Would the answer be different if LLP is an associate or joint venture of H Limited? This also I clarified, irrespective of the fact. Now we have to consolidate associate or joint venture also. Whether the parent is required to consolidate subsidiary which has been acquired with intent to dispose of in near future. IGAP we can have an exception, but in IND AS we have no exception. We have to do the consolidation. Entity X has two subsidiaries at the end of the previous reporting period, which is consolidated in the consolidated financial statements prepared in accordance with IND AS. During the current period, Entity X disposes of its investment in both the subsidiaries and consequently does not hold any subsidiary on the reporting date. Whether it need to prepare a consolidated financial statements. So as I told you, from the date of acquisition to the date of cessation, we need to consolidate. Accordingly, since the transaction happened during this year, we need to do the consolidation. AB Limited holds 90% stake in face value of 90,000, total value of 1 lakh. The relevant activities of ABC Limited are decided upon the simple majority vote, and thus AB Limited exercises control. BC Limited holds 88% stake preference shares having a aggregate face value of 170 in ABC Limited through its issued fully paid up preference share of 2 lakhs. In the facts of the case, the voting rights of BC Limited as a preference shareholder are governed exclusively by the provisions of the Companies Act. So here the second provision of section 47(2) provides that where the dividend in respect of the class of preference shares are not paid, then they have the voting rights also. So in this case, ABC has not paid the dividend. So now we have to reassess the control. So since they have not paid the dividend, we need to check whether there is a change in the control definition, and accordingly we need to see whether we need to take that consolidation process. This I already clarified. Parent company holding 4 subsidiaries, each subsidiary is having 20% in another entity, by virtue it has 100% control indirectly. So we need to consolidate. How should the parent make intragroup elimination in consolidated financial statement when the parent and subsidiary do not have the same reporting period? This has to be done as a memorandum of adjustment. So there is no option. We have to eliminate intragroup transaction. How should asset and liabilities be classified into current and non-current when the parent have different reporting? It happens because in standalone financials we will shown as a non-current, but when the consolidation happens 3 months later, it may become current. We have to do the memorandum changes and do the adjustment at consolidated level. That is all. So any clarifications, please let me know. Thank you.
Thank you, sir, for your valuable insight on the topic. We appreciate the time you've taken to be here with us and take part on this celebration, sir. So we have our next session with C.SHANKAR Raman, sir. So after the tea break, we have an inspiring session with Shankar Raman, sir. So members have a short tea break and come back in 10 minutes. Okay.
In financial reporting. He has extensive experience of leading and coordinating large national and multinational audit engagements. He is responsible for managing client relationships at CEO, CFO, audit committee level, and was also instrumental in developing innovative service offerings. His experience also includes performing financial due diligence and internal audits. He also specializes on internal controls, design, and testing, both as per requirements as required in India as well as SOX. His area of specialization includes statutory audits in financial services sector, manufacturing, power retail and distribution, and consumer business. He has also handled engagements in other sectors like healthcare, publishing, automotive industries, and NGOs. He has done audits under auditing standards generally applicable in India, international auditing standards, US, GAAS, and PCAOB standards. With this short introduction, we would like to thank CA Shankar Raman for accepting our invitation. SIRC also would like to invite CA Chakravarti to present the small memento to the speaker. Over to speaker.
Good evening, everyone. Hope I'm clear and audible. And so, thanks to SIRC for providing me with this opportunity to be here this afternoon on a day-long session being conducted on the Accounting Standards Day. The topic that I would be covering would be the emerging topics, Indian Accounting Standards and IFRS. So, I'll be presenting my session in two parts. The first part would talk about certain recent developments that has happened in Ind AS, and the second part would probably be taking up a few standards and talk about certain disclosure deficiencies that we generally see or practically happen to come across, or which has been pointed out in reviews done by either FRRB or QRB. It's not going to be a detailed session on those respective standards, but just wanted to give a highlight in terms of how the reviewers and regulators looks at our financial statements. So, if I have to start with my first topic on the recent developments, more so it would be from an Ind AS perspective. As we all know, we started our Ind AS journey about 7-8 years ago. 2017, I think, was the first year when certain companies were mandated to follow Ind AS. So, India, when we started with Ind AS, we formed the new standards called Indian Accounting Standards, which was majorly drawn from the International Financial and Reporting Standards. But as people would be aware, not all the clauses or all the conditions of IFRS was included under Ind AS. To meet the situations of the Indian local regulatory requirements, there were certain carve-outs. So, when on the transition date, whatever was the IFRS standards, there was an equivalent Ind AS standards that was issued. If IFRS 2 talks about inventories, there was an Ind AS 2 which was talking about inventories. More or less the principles were drawn from the IFRS standards, but as I said, if there was some specific carve-outs which needs to be done to meet the Indian situations, those carve-outs was included as part of the Indian standards. Say for example, there were carve-outs on how you treat the foreign currency translation differences in India. As we would be aware, under the old AS 16 or other standards, we were capitalizing a part of exchange difference when it comes to long-term monetary assets or liabilities. It was left in the balance sheet to be amortized over the period of loan. So this was left as a carve-out. So if people have chosen that option when they were doing the financial statements under the old GAAP, they were allowed to carry it forward under Ind AS regime also. So there were about 6-7 carve-outs like this. Say for example, when it comes to leases, straight lining of rent. The carve-out that was made was in case if you feel that the rental increase that we give is more to meet the inflationary increase, then the straight lining need not be run. But that was the start point. But as the years gone by, both the regulators in India as well as the ASBs, etc., they wanted to have as minimum difference as possible between the Ind AS standards and IFRS. That is because the manner in which Indian companies are going global. So the next set of standards that came in, say IFRS 9, IFRS 115 or in IFRS 116 and the equivalent standards that was issued in India, there were not much differences between what was there under IFRS and what we had under Ind AS. To be if I can recollect correctly, the standard on leases, I think India implemented first and then only the standard became mandatory of the IFRS because we had the March year end. So why is this background very important is because as and when there are regulatory changes that is happening in the IFRS world, there is a consequent change which is getting attempted under the IND AS world too. So now let us, this half of the session would talk about certain key changes that has been already given under IND AS based on the corresponding changes in IFRS, or certain changes that is going to happen based on the changes which are proposed at the IFRS level. So why is it important to have a very little difference or a no gap between IND AS and IFRS? This is because we are going global. There are global investors which are coming into the country. So when they look at the financials, they should have the understanding in the same manner that they would have an understanding if they look at the financial information published in any other part of the world. 1. 2. They also want the disclosures and the manner in which the financial statements are presented to be in the same consistent manner which they are used to globally. So considering these aspects, it is requirement even under ICAI regime or the NAFRA requirements to have the standards or the amendments to be as close as IFRS possible. That's from a business perspective. Why, as a professional, it is very important for us to keep tab of these changes, because ultimately when both sides, whether we prepare the financial information from the client side or we do the audit from the other side, we need to be aware of the changes which is happening, because in this again the global environment, the changes are happening very fast. Okay, now how is the economic situation today, the geopolitical situation today? We have the Ukraine war, we have the US regime, the reciprocal tariffs which has been issued. There are climate related challenges which are very important to the stakeholders because of the relationship between the sustainability reporting and the financial reporting. So because of these changes, they may have a very significant and direct impact on the financial reporting perspective. So it is very mandatory that there is an accurate and timely financial reporting which is possible and which has to be made to ensure transparency, building the trust, ensuring compliances and meet with the regulatory changes. So what are all such important changes that has happened which we should be aware as professionals? I have taken about 4 minimum changes which has happened. So we'll briefly dwell upon these changes and how does it impact our reporting obligations. Also, as I said, when there is a change which is happening in the IFRS world, there would be a corresponding change from an IND AS perspective. So what are those changes? IND AS 40, as we all know, it talks about investment properties. The option which is available presently is to show the investment properties at cost. The IFRS standards has been modified to include fair value options for investment properties. So that change is going to come into the IND AS 40 also. There is going to be one big change which from the financial reporting perspective. See, as we all know, Schedule 3 defines the manner in which the financial statements are presented. And when people move from the old IGAAP to IND AS, then IND AS 101 provides the manner in which the financial statements needs to draw up. Again, globally, there is a new standard which has been issued, which is IFRS 18, which is applicable from 1st January 2027. So the ICAI has also issued an exposure draft, IND AS 118, which will talk about the presentation and disclosure of the financial statements. I'll be briefly touching upon what would be some critical changes which one can expect once IND AS 118 becomes effective. The other change is IND AS 119, which is subsidiaries without public accounting. Again, here no exposure draft has been issued, but since the IFRS has already introduced, we can expect something to come from an IND AS 119 perspective also. So I spoke about 4 major changes that has happened recently. The first one is on classification of liabilities, whether it's a current or non-current. So as we all know, under the Schedule 3 financial statements requirements, any asset or liability should be classified either as current or non-current. So one of the definitions that we generally use is that if something is expected to be collected or paid within the next 12 months, okay, it uses the word operating cycle, but generally we map it to 12 months, we put it as current. One of the important carve-outs that was made here is with reference to borrowings and the consequent default or non-compliances of covenants with reference to those borrowings. So before understanding what is the consequence, let us understand one key definition which defines what is a current liability. Under IND AS 1, an entity classifies a liability as current when they do not have an unconditional right to defer settlement for at least 12 months after the reporting date. So the key word here is unconditional right. So when this classification came up, one of the examples that we were discussing was a provision for leave encashment. So we give it to the actuary, he does the valuation, he gives the split between current and non-current based on the past trend. But one of the discussions that the corporates were having was, okay, this is nothing but a valuation of the leave credit which is available to the employees. What if all the employees come and ask me the leave? So since there is a credit, we will not be able to say, I will not grant the leave. So you may not have a right to defer it. So since you did not have a right to defer it, whether the entire provision for compensated absences should be shown as current. So this was one of the discussions that happened when this definition came in. Again, there are multiple practices, I am not getting into it, but the word unconditional right had a significance. Now coming to the borrowings. So the literature which presently is states that even if in case there is a default as on the balance sheet date, which may be either because of you not paying the EMIs or you not meeting the covenants of the loans, if the lender has agreed either during the reporting date or even after the financial year before the financial statements are due for issue, that he will not demand the payment because of this consequential default, still you can show this as a non-current liability. So this was left to the negotiation or the discussion between you and your banker. If you feel that he will not demand the payment, the classification still stays as non-current. So this is going to be modified in the sense that if you are not able to unconditionally defer, which means on the date of the balance sheet, you should have substantial evidence that he will not recall the loan, which means he should have given you a letter or a sanction stating that in spite of the default or the delays or not meeting the covenants, we will not call back the loan. So that condition should exist on the balance sheet date for it to be continued to be classified as a non-current. If this is not available, then you may need to reclassify it as current based on this. So this carve-out which was available, which gave you time till the date of financial statements, is going to get removed because of this amendment. When it comes to covenants, the covenants should have been existing and you have to comply it as of the balance sheet date. So it does not depend on the covenants that you would be complying after the balance sheet date. That's the one key point that you need to consider. The second point that you need to consider is, what if you are going to issue your own equity instruments to settle those liability? You have a borrowing. So if you have a discussion with your banker stating that you will not pay cash but you will issue equity. So in those cases, what will happen? Again, the standard deals with depending upon the kind of equity instrument that you give, whether it's going to be pure equity shares or whether it is going to be convertible instruments. So those are the nuances which are going to be dealt with when it comes to the classification of current versus non-current. There are also going to be some additional disclosure requirements. You will have to talk about the nature of covenants, what are you required to comply with, what is the carrying amount of the related liabilities, and if there is going to be any conditions which should give a rise to the fact that you may not be able to meet those covenants in the future. So these would be certain disclosure requirements that would come up in the balance sheet. So the key point in this amendment is to ensure that you be careful in your analysis of whether the borrowing needs to be classified as a current or non-current in case if there is any breach of covenants or in case if there is a delay or default in repayment as compared to the original sanction schedule. The second amendment is with reference to supplier finance arrangement. So we all know how a supplier finance arrangement works. I as a company, I need to purchase goods. I have a supplier who supplies me goods. Generally it is either on an advance payment or I will be getting a credit. Okay, I need to manage my working capital. So if my supplier says advance payments, I need to block my money to get the purchases. Now comes the third party. If there is a financier, if there is a financier who comes and tells me, okay, I will meet the liability of the supplier on day 1, but you can make the payment to me after 90 days. Yes, of course, subject to your interest and other things. So there is a tripartite arrangement between me as a company, my supplier, and the financier. So I purchase the goods by making the payment, the supplier makes the payment, the financier makes the payment to the supplier, and on the due date I settle my financier. So how is it getting accounted? So there will be two things. One, what is the classification of this in the balance sheet? And two, how is it shown in the cash flow statements? So classification in the balance sheet, generally I have seen people putting it as trade payables. So instead of party A, you put party B as a trade payable. So which means the reader of the financial statements will not have any information as to what is the exposure that you have from the overall supplier financial reliability. One. Two, if you put it under trade payables, even under cash flow, you will not have this information, because you just say increase or decrease in trade payables by giving the difference between the closing balance and the opening balance sheet. So there is a significant financing arrangement which is involved. The reader will not know what is the kind of arrangement, what are the risks which the company is exposed to, whether there will be any liquidity constraints, what is the quantum that we are talking. So those things are not presently available in the financial statements because there is no mandatory disclosure requirements. So the amendment here is that they want you to disclose all these things. So you have to tell me, okay, this is my trade payable, this is not subject to supplier finance, this is my usual credit period. Okay, this is the trade payables on which I have had supplier finance, and this is the credit period. So people can compare, okay, here the credit period is 90 days, here it is 30 days, or here it is 30 days, here it is 90 days. Then you also need to give the quantum of such transactions which has already happened and what is due to be settled. So there are certain disclosure requirements coming up because of this amendment, so that the reader of the financial information gets a complete idea in terms of what is the supplier finance arrangement, the quantum, the terms, the conditions, the exposures, and other details which would be available, which was not there in the past. So it gives the carrying amount, the associated line items in the balance sheet, for which the financing has been availed, for which the financing has not been availed, give the indicative due dates. So it gives more visibility and understanding to the reader of the financial statements. From the balance sheet perspective, I said generally it's part of trade payables, but based on certain agreements, I have also seen certain clients putting this as part of your short-term borrowings. So both practices are there. So you will have to review the specific agreements and see whether it fits into the definition of trade payables, or you need to classify it as a short-term borrowing. So that's the second important change. The third important change is the introduction of IND AS 117, which is on insurance contracts. So they had 104, now it is going to be 117. The crux of this change is that when we say insurance contracts, unless we are in the insurance company or we audit an insurance company, we may take a view that this standard is not applicable to us. But one of the significant changes that has happened in this standard is that even though if you are not an insurance company, even if you are a manufacturing company, for example, if there are going to be certain insurable risks in your organization, then those risks are also covered and which needs to get accounted as per the standard. So let me go in detail into this. So before that, we need to understand the flow. First you see whether there is a contract, then you see whether there is a counterparty for the specified uncertain event. 3, you see whether there is a future event which would adversely affect the counterparty, and 4, you see whether the non-financial risk are transferred from the counterparties. So once you apply this standard or the flowchart that I have given, you see whether 117 would be applicable or not. From an insurance company perspective, they would be having more such contracts here, but from another manufacturing company perspective, the thing that we need to show is that contracts that do not have a legal form of an insurance contract but transfer significant insurance risk may also meet the definition of the insurance contract and be subject to the requirements of 117. So that's the significant change which comes from an 117 perspective. So it is going to be a very complex assessment and a significant judgment area. So some of the aspects that you need to consider is who is providing the product warranty, whether there is any fixed fee for roadside assistances, whether there is any performance bonds or surety bonds or bid bonds, etc., whether there is a loan which has been issued with a waiver clause, whether there is any guarantee for a minimum output. There are also self-insurance groups. So the standard provides you certain important aspects that you should analyze to see, in spite of you not being an insurance company, this standard would become applicable and relevant to you. So what is an insurance contract? It is defined as a contract under which one party accepts significant insurance risk from the other party by agreeing to compensate the policyholder if a specified uncertain event adversely affects the policyholder. So the definition focuses on transfer of significant insurance risk arising due to uncertain future event from the policyholder to the issuer. The term insurance risk is defined as the risk other than financial risk which is getting transferred. I know it's slightly complicated, and we are not, as a typical auditor, we have not started applying to see whether any of the agreement or arrangement which your client has would fall into the definition of an insurable risk. So that is going to be one of the important aspects which we need to consider. So I am sure that the standard getting introduced now, there are going to be lots of materials which is going to come in terms of helping us analyze on how or whether this new standard would have an impact on our clients or the company in which we work. So uncertainty here would mean one of the following. What is the probability? We do not know. What will be when will it happen? We do not know. And what will be the cash outflow? We do not know. So everything is a question mark. So generally any insurance claim, that's what would happen, right? So there is going to be a significant unpredictability against which you try to take a policy which would cover these risks. So we would be applying the same kind of definitions, but it would be applied for the various arrangements that you presently have in your organization for you to see whether it would get applicable to you. The standard provides certain carve-outs. They say the warranties which is being provided by the manufacturer or employer asset and liability in your IND AS 19, contractual rights and obligations which is covered under other non-financial items, residual value guarantee which is generally coming in leases, financial guarantee contracts, contingent consideration, credit card contracts. So these are certain exemptions which has been given in the standard. So this is just a very short nutshell of what you can expect from an accounting perspective as this accounting standard has become mandatory. The last important amendment that has come is on lack of exchangeability. See, we may have foreign currency balances or foreign currency denominated transactions, or we may even have a subsidiary or an associate which is in a foreign country. So at year end, as we all know, we need to have either a consolidation as was dealt with just before, or you need to restate your foreign currency balances if it is a monetary asset or a liability. So generally we get the exchange rate if it is a euro or a dollar, and we do the conversion either for monetary assets and liabilities or for consolidation purposes. What if you are dealing in a currency or you have an exposure in a country where there is a risk of exchangeability, meaning you will not be able to freely exchange that country's currencies to INR. So in those cases, how do we meet with the requirements of IND AS 21? So to answer this question, there is an amendment which has got. So typically in any circumstance where we don't have an answer, the judgment and our estimates and assumptions comes into play. So in this particular case, how do you judge or assess what could be the spot rate at which this conversion should happen? So again, in any standards, if you look at, if it is a significant judgment which impacts the financial statements, there should be a detailed note into the financial statements on what is the basis of judgment, how did the management come about it. Those disclosures should be available for the users of the financial statements to understand the basis and the rationale based on which the judgment was there. Again, this amendment also wants you to make such disclosures into the financial statements. The nature and financial effects of the currency not being exchangeable, the spot rates used, the estimation process, the risk to which entity is exposed because the currency is not being exchangeable into the other currency. So again, this is a minor amendment, but in case, again, as I started the discussion, because of the geopolitical world, if there are going to be challenges in the exchange of currency with which you deal with it, this amendment would come into play for your operation. Not expected to be applicable widespread, but again, to be in line with IFRS, the IND AS have made this change. So this is just a quick run through of certain key changes that has happened in the accounting world because of the consequent to the changes in IFRS. What could be the changes that could come in IND AS? So when you do the audit for the current year, in case if you feel that these are going to be relevant to you, you may need to have a more detailed understanding of these changes. I feel at least based on my understanding and discussion with the clients, the supplier finance arrangement is something which is very commonly prevalent in many of the companies, and that particular transaction would have impact on the financial statements and the disclosures in case if you as a company deal with it or you as an auditor come across and audit it. Okay. The next discussion that I would have would be on IND AS 118, sorry. This is an exposure draft which has been issued by ICAI. This is to make the standard which is relevant to IFRS 18, which is applicable from 2027 onwards. The exposure draft is available in public for the comments, and this would become applicable once it is notified by NFRA. This is going to replace IND AS 1, as I said, 101, sorry. When you transform from your old IGAP to IND AS, 101 provides you the principles on how you need to go about it. So this standard will be a replica. So what it had done is, whatever is relevant in 101, if there are not going to be any changes, the same thing has been carried forward. And wherever there are going to be changes, the new revised guidelines have been issued. And because of this, when you see 101, there will be a reference to lots of other standards. So because of 118, the consequential changes on the other standards have also been made and will be notified once the mother standard gets notified. So what is the one important change because of IND AS 118? It is the manner in which you present your P&L account. So we all know how the present P&L is there. We have revenue, we have other income, then from the cost side we have cost of materials, inventory changes, employee benefits expenses, maybe other expenses, finance cost, etc. So that's the traditional manner in which we draw up the financials, profit before tax, tax and profit after tax. But here the important crux of the change is that you need to give your P&L split into operating activities, investing activities, financing activities, income taxes and discontinued operations. And there are also additional disclosures which are required, which would be new subtotals, management defined performance measures and certain grouping. So let us start with the financial statements. The moment I say operating, investing and financing, our mind goes to IND AS 7, the cash flow requirements. We all know that the cash flow is presently being made in that manner, wherein we give the operating cash flow, the investing cash flow and the financing cash flow. When I read through this standard, the first thing that struck me was any analyst would first compare what is your operating profit to what is your operating cash flow. So the moment there is a big mismatch, it could raise red flags. I think that would be one of the very important reasons on why you want the P&L to be drafted in this manner, and this consequent amendment is coming in, because we all know as experienced accountants on how different a profit and loss can look as compared to the cash flow of that entity. So there is all possibility that that will get thrown up if you draw up the P&L in this manner. So that should be, I think, the crux of the change. I spoke about it, and this is going to be effective from 1st April 2027 as it stands now. An operating category, as we all know, it gives you the operating activities of the company. It can be the main activity, it can be the sub activities that can be there. This would be a kind of residual thing, because you know what is investing, you know what is financing, and all other things would probably get into the operating activities. Within the operating activities of the P&L, you can either give it by nature of expense or you can give it by the function. Which is presently available to draw up your P&L is also available from an 118 perspective. So this is how the investing activity, we all need to know what are all the investments that you have made, and how does those investments give you return. It can be your bonds, it can be your surplus funds in mutual funds, it can be your investments in subsidiaries. So the activities relating to those activities in terms of your income and expenses will get into the investing activities. And financing, how do you fund it? It can be either 116 lease related liabilities, or it can be the borrowing. So what is the P&L which impacts the financing category? So your whole P&L will get split into operating, investing and financing, and then you give your taxation, which is something similar to profit before tax, the taxation, and the profit after tax. And discontinuing operations, even though there is a separate disclosure requirements as per the standard. Yes, sir. That will come in investing activities, sir. Yeah. Yes, sir. It will also come, sir. It will be just your borrowings, predominantly your borrowings. Your loans from banks, the loan taken from you by banks, or your IND AS 116 leases. So those could come under financing activity. So it is from the perspective of the manufacturing company that we may need to look into it. So again, as we all know, there could be some specific industries, NBFCs. For example, if I can take up this discussion, NBFC, the main business is to borrow funds and lend funds. So there I cannot put my lending funds as investing and borrowing funds as financing activity. So if it is going to be an NBFC company, then this falls into the operating activities. That's how we do the cash flow even now for the NBFC's business. We show the interest income and interest expense as part of the operating cash flow and not as part of the investing cash flow. So that is still available in this 118. But I think this is the guidance note, sorry, the ED is there. And once the standard is issued, there are going to be materials and education materials that would come to help us on this. But this is going to be one of the very critical changes. See, we moved from Schedule 3 and we have Schedule 6 earlier. Then we moved to Schedule 3 and we moved from IGAP to IND AS 101. From 101 to 118 is going to be another journey which is going to come up in the next couple of years. The next thing is subtotals. It says there are two mandatory subtotals which needs to be there, which would be operating profit or loss before financing and income tax activities. We put gross margin now. So there are a couple of mandatory subtotals which needs to be given. The most important change, other than the way in which P&L is presented, again I use the word presented here because the manner in which you measure is not going to change. So if it is going to be inventories, you are still going to measure the inventories and changes in inventories based on your principles of IND AS 2 or AS 2. But how you present it could undergo a change based on this standard. So your overall profitability may not change, but the manner in which you present the P&L under the 118 standard is undergoing a change because of this change. The next important change is here something which is called management defined performance measures. So what does it mean is that the standard proposes to introduce a definition of management defined performance measures and requires an entity to disclose the information about all management defined performance measure in a single note to improve transparency. So when you see analyst call, when you see their MD&A, when you see the transcripts, we find a lot of information which is given by the management. The manner in which they dissect the P&L would be completely different. Say for example, they may say EBITDA, which we all know, they may say EBIT. So they may say operating cash flow before depreciation, something. So each and every management would focus on a particular manner in which they would like to present their financial information so that the readers or the analysts would be able to appreciate their numbers. So what is happening is that in sometimes the reader is not able to understand the link between these MDPs and the amounts in the financial statement. Certain things could be straightforward. When you say EBITDA, at least we as accountants will know what are the things which we need to adjust from the profit to get into EBITDA, but not all the professionals or other people may be able to do it. So this standard requires two things from us. One, you put all these MDPs in a particular place so that the reader would be able to understand and appreciate it. And two, it also asks you to give a reconciliation between the major MDPs and the financial information, so that the people will understand how the information in the financial statements is getting flown into the MDPs. So this would be some critical changes that are going to come once you put 118. And the last, it may not be very significant, but the standard says that the usage of word others should be very minimal, because here what we see is that in any schedule or note that you see, we'll have something as others. Other financial assets, the header itself will be other financial assets, and within that we'll have something as others. So try to give as much information as possible to the readers, and try to minimize the use of word others is also getting stressed in the standard. So this is quick tracks of the 118. As I said, please go to the exposure draft. You will have some clarity. IFRS have already, I think, issued the basis of conclusion on the logic and rationale on why these changes are required. That's one good thing with IFRS, because when the standard gets issued, you also get the basis of conclusion, the manner in which the discussion took place, what were the pros and cons, what were certain things that came up, discussed, but not finding part of the overall standard. So those things would be given as a commentary when any new IFRS is getting issued. Going back to my initial statements, IND AS would be more or less similar to IFRS. So once we start reading those documents, we would be able to appreciate the logic and rationale on why certain changes are made or changes are considered, or why certain disclosures are required or not required to be made. So one last important update is on the accounting standards for limited liability partnerships. As we all know, I think we already have the major standards that needs to be done for non-corporate entities, level 1, 2, level 3, 4. Now there is an exposure draft for limited liability partnerships. Again, they are trying to standardize the manner in which the LLPs needs to present their financial statements. Again, it's in an exposure draft. There is a definition which is given for what is a small and medium sized LLP. So once this gets into standard, if you are having LLP audits, or if you are part of an LLP in any organization, then these accounting standards would become mandatory to you. So that's the first part of my discussion. If I have to quickly summarize, we spoke about certain major changes or some minor changes also on the accounting standards world. The exchangeability, we spoke about the exchangeability of foreign exchange, we spoke about the supplier finance arrangements, we spoke about the classification of a liability as current or non-current. We touched upon 117, we touched upon 118, but I'm sure that there are going to be lots of opportunities in professional forums to discuss on these aspects, and we gain more knowledge for us to practically implement. I'll take a minute pause. If there are any specific suggestions on these topics, we can hear out. Otherwise, I can get into the next part of my discussion. Could be overwhelming a bit because we need to practically see and implement how it works out. But at least from an awareness perspective, I think once you get into this transaction, you may remember that yes, there is some amendment this, and you would be able to appreciate it. So let me go ahead. Okay, when ICAI called me, they wanted me to have some discussions on the present accounting standards. So I was discussing, and they told that consolidation standards are already being dealt. So I thought I've done a few sessions on accounting and measurement. So I thought I will touch upon disclosures. So because what is happening is that even when I practically review the set of financial statements, or when we look at the QRB reports or the FRRB reports, there are apparent disclosure deficiencies which is getting caught. So I just picked out a few disclosure deficiencies from this published report, or the ones that I have seen practically, just as a highlight stating that please be aware of these disclosure requirements. I picked up 4 standards: cash flows, EPS, related parties, and segment. It is not going to be a complete run through of these standards, but just on the disclosures or the practical challenges, I thought we will have some discussions. When I read through the FRRB reports and QRB reports, there were some very apparent errors which are there in the financial statements, which we as professionals should avoid. Say for example, EPS. we all know that we take profit after tax as the start. So the profit after tax as per the P&L and the profit after tax considered for the EPS note was not tallying. Cash flow statements, we add back depreciation. So the depreciation charge as per P&L and the amount of depreciation that we added back in cash flow was not tallying. So we should ensure that our juniors spend some time and do the tick and tie so that apparent errors are not there from these disclosures, because when we look at the reports, these are one of many of the errors which are getting pointed out, and regulators being regulators, they say that since this is not there, we have not complied with the particular standard. Fine. I had an experience of undergoing an QRB review. Again, they were very particular on the disclosure requirements of the standards. See, one thing is to look at my quality controls, internal procedures, etc. But when it came to accounting standards and auditing standards, particularly from an accounting standard perspective, they wanted to ensure that the financial statements that they do the review did not have any disclosure gaps. See, one of the learnings that I had, say for example, it was under related party transactions. I faithfully disclosed the name of the parties, the relationship, the transactions, etc. But I was pointed out there was one deficiency based on this particular paragraph, stating that you have not disclosed whether these balances are secured or unsecured, and you have not disclosed how will the settlement of these transactions happens. So when I went back to the standard, yes, these were mandatory requirements for disclosure. Okay, I started arguing, okay, this is a related party disclosure for debtors. You go to my debtors, I say everything is unsecured. I have not given any debtors as secured. So which means that any related party debtor which is disclosed here is also unsecured. I said no. That's a different disclosure where you say secured debtors is from a Schedule 3 perspective. What I want here is from an IND AS 24 perspective. I'm not criticizing, but just to drive home the fact that as equal as measurement where you want to get your profitability correct, there is an equal importance which is being given from a disclosure perspective also. So what are some disclosure challenges? Leases. See, as we all know, under IND AS, what we do, we put the ROU asset, we put the lease liability, we amortize the ROU assets, we provide interest on the lease liabilities, and we pay the rent, which will be a reduction to the lease liabilities. When it comes to cash flow, we show the lease liabilities as a financing activity. So the disclosure requirement here says that you don't just say payment of lease liabilities, because there is another disclosure requirement which says you also need to disclose what is the amount of interest paid. So they say that you have to split the payment of lease liabilities into two: payment of principal towards lease liabilities and payment of interest towards lease liabilities. Again, also learning to me when I read through the standard. Long-term borrowings under cash flow financing activity, it should always be at gross level. So you have to show separately what was the borrowings that you have taken, and you have to show what is the borrowings that you have repaid. Only the short-term borrowings can be a net presentation. See, there is not much to discuss, but just wanted to highlight the kind of deficiencies which we are noting. One of the important disclosures in cash flow is to give a reconciliation which is required by IND AS 7, which gives you the movement from opening to closing. So you take the opening balance, you put the new borrowings taken, the repayment of borrowings, any reclassification that has been done, any fair value adjustments at the closing balances. Generally, this disclosure table below the cash flow statement, people miss out. So this should be given for leases, the long-term borrowings and the short-term borrowings, so that it gives a bird's eye view on how the borrowings have moved during the year in respect of your entity. For cash flow, we always start with profit before tax and add back non-cash items. So when you see the P&L, you will have lots of non-cash items. It can be bank debt written off, it can be provision no longer required return back, it can be depreciation expense. So review the P&L, identify what are all non-cash items, and ensure that you add it back properly. The challenge is provision for gratuity and provision for leave encashment. I have seen mixed practices, whether this is a non-cash or it is a non-cash. My personal view is that this cannot be treated as a non-cash item, because ultimately you will end up paying cash towards settling the leave liability or the gratuity liability. So my personal preference is that we don't add back provision for gratuity and leave encashment when you do the cash flow statements. You have to take profit before tax. So when you look at the IND AS P&L, you will have the P&L and you will have the OCI. The start point for cash flow is profit before tax, which means OCI is ignored. One of the key items in OCI would be gratuity. So how do we present it? Some people, when they took profit before tax, they adjusted the gratuity amount in OCI and then disclosed the number, which is not correct, because the standard says just take profit before tax, and the standard does not say take the total comprehensive income. So you take with profit before tax, but the gratuity portion which is disclosed as part of OCI, you can adjust it as part of the gratuity provision movement, which would be part of your operating activities. That is what the standard requires. We all know what is other bank balances and what is cash and cash equivalents. The definition are there in Schedule 3. So cash and cash equivalents, you give a reconciliation between opening to closing. That is what is getting reflected in the cash flow statements. When there are other bank balances, then the changes in other bank balances should be part of your investing activities. To answer your question, sir, since I have bank deposits and which there's nothing but the surplus funds invested, or it can be some major deposits that I make against any disputes or a lien for your borrowing. So the cash flow also wants you to report it as an investing activity in any company. No, that is my borrowing. That's correct. That's correct. So for example, I have surplus funds. I put it as a fixed deposit in bank. That fixed deposit will earn interest income. That will be an investing activity in my cash flow. No inflow. Your financing activity, the only inflow can be your new borrowings or share capital issued. Both can come there, yes. It can be even if there is a new share capital that has been issued, that comes as a financing inflow in your cash flow statements. That will be as a financing activity in your cash flow. Both can come, yes. Sorry? Dividend income? Dividend income would be an investing activity. Dividend paid would be a financing activity, because the dividend paid is nothing but a return to your shareholders. So that would be part of your financing activity outflow. Yes, sir?
Short-term borrowings and repayment, you can net it off and show.
Yes, sir, we can net it off and show.
Or there's an option.
The standard allows you to net off, but your transaction is huge that you want to show it at DOS level, I'm fine. But the standard provides you an option to net it off when it comes to your short-term borrowing. But for a long-term borrowing, it is mandatory that you show the proceeds and repayment separately.
What happens is you have two short-term borrowings. One you have repaid, the other one, can you still net it off?
Yes, sir. So we just see what is short-term borrowings on the face of balance sheet. The difference we show it on the cash flow statement.
Sir, in this case, there will not be segregation for capital revenue.
No, sir. No, sir. Both will mix, sir. See, when I see investing activity, your first line will be purchase of fixed assets. My second line will be interest income from bank deposits. Third line would be investment in your subsidiary. So there is no capital revenue segregation when it comes to cash flows, sir. It only goes by the nature of transaction. It is an investment. Whether you have invested in fixed assets or whether you have invested in a subsidiary, or you got an income from investment into any of your income, like the dividend example I gave. So it goes by nature and not by capital or revenue.
Dividend comes in financing.
Dividend income comes in investing activity. Dividend paid comes in financing activity. So, yes, sir.
In AS also you can do that net off.
Yes. Again, one other learning which I had yesterday when I was looking at is unclaimed dividend account. So you know that once you declare a dividend, you need to transfer the funds to a separate bank account, and if there is any unpaid dividend, that will still lie in that bank account. You have to use it only for settling the dividends, and if it is not settled, after 7 years you transfer it to investor education and fund account. So the requirement is that this is still a bank balance, so it has and meets the definition of cash and cash equivalents, but it is restricted in use. So though it is treated as a cash and cash equivalent by definition, since there is a restriction, you need to segregate and show it when it comes to the cash flow statement. So your balance sheet will show it as a cash and cash equivalent, but when it comes to cash flow, you need to remove it and show it as an investing activity. So you just need to take care of this when it comes to a dividend account or a share application money, etc., etc. Borrowings is very important here because you may have cash credits and you may have temporary overdrafts. So you have to see the intention. There is a judgment which comes in. If it's a cash credit where most of my working capital requirements are met by cash credit, then it becomes a short-term borrowing. But if it comes to a temporary overdraft, it can still be treated as a cash and cash equivalent because if it forms part of your cash management. So you need to understand how your entity manages cash and then deal with cash credits or bank overdraft accordingly. There is no one fit answer, but it all depends on the manner in which your company operates your cash flows. Earning per share, as I said, the discontinued operations, the EPS should be shown separately between continuing and discontinuing. We have to have a disclosure which talks about the numerator being profit after tax, the denominator being the weighted average number of shares, the face value and the EPS. Sometimes this disclosure is getting missed. We have to take profit after tax and don't consider OCI when it comes to computing earnings per share. Related party transactions, see what happens in most of the situations is that one, we don't disclose all the parties. Two, even if we disclose the parties, we don't explain the relationship properly. And three, how do we disclose the nature of transactions? Because the standard says you can have a level of aggregation, but the level of aggregation that you do should be meaningful. For example, if I purchase from my subsidiary company and also sell it to that subsidiary company, you cannot put purchases and sales together and say this is the volume of transactions because it may not give any meaningful insights to the reader. So you give purchases value separately and the selling value separately. So you do the aggregation in such a manner that it provides meaningful insights to the reader. Two, the basic requirement is that you try to give the transactions for each relationship separately, meaning joint ventures, KMPs, associates, subsidiaries. Don't combine these things. Don't say you purchased from associate and purchased from subsidiary and put it together as purchases. So try to have the classification for each kind of transaction and each nature of relationship, so that it gives a meaningful understanding to the reader. Because in today's world with NAFRA, listed companies, circulars, audit committees, the related party transactions is very important and draws a lot of attention of the readers. One. Two, from an audit committee and SEBI perspective, the arm's length pricing, etc. is very relevant. So three, when we do the 3CEB report or the transfer pricing report, the base is the related party transactions that you disclose, and if there is a mismatch between the related party transactions and the 3CEB, you may have challenges from an assessment perspective. So ensure that the financial statements of related parties discloses things in a manner which is clear, concise and meets the regulatory requirements. The other question from an IND AS perspective is whether the non-executive director should be shown as a related party. We all know that KMPs needs to be shown, that is KMP from a Companies Act perspective. But when we looked at the definition, a KMP are those persons having authority and responsibility for planning, directing and controlling activities of the entity, directly or indirectly, including any director, whether executive or otherwise. So there are many corporates which have taken the view that because of this definition, all the directors would be given, which was unlike the situation when we are doing the disclosure under AS 18. AS 18, we only disclose managing director or whole-time director, but under IND AS 24, we ended up disclosing all the directors because of this situation. And one last thing on related party is coming to the KMPs. So what happens in KMPs is two things. If you pay salary, generally the requirement is to show what are all the kind of payments that has been made, meaning you need to show what are the short-term compensation, what is the long-term compensations, etc. We generally don't have that split up. See, short-term employment benefits, post-employment benefits, long-term benefits, termination benefits. This breakup is not there in the financial statements. 1. 2. If there are salaries to more than 1 KMP, you have to give it by name. But sometimes what happens is that you just have one single disclosure, payment to KMP is rupees X crores, without giving the breakup by name. I think both of these requirements, putting it by name and giving the nature of payments is important from an IND AS 24 perspective. Segment, there is a key change between IGAP and IND AS. IGAP was more from a control perspective, and we generally define segment as primary and secondary. Primary can be by the nature of transactions or the nature of products or the business, and secondary can generally be by geography. I have seen the other way around also. I have seen a company which is on trading and distribution with lots of international operations showing the geographic segment as a primary segment. So it all depends on how the management views their transactions. But when it came to an IND AS requirement, it operates on the manner in which the CODM, which is the Chief Operating Decision Maker, reviews it. So there is no segregation between primary and secondary. So it all depends on how the CODM looks at the financial information and how he concentrates his efforts and the resources. So we have to look into the MIS and ensure that how the CODM looks at it would be the manner in which the reader of the financial statement should also understand and look at your business. So that is one significant change which is under IND AS as compared to AS when it comes to a segment reporting perspective. One big challenge here is they may say CODM looks at a company as a whole, as a single segment. That's how my efforts are directed. In spite of that, the standard requires you certain mandatory disclosures, which would be the revenue by product or revenue by geography. If there are any non-current assets, which are, where is the location of these non-current assets? Is there any customer or a transaction or an exposure to any party which is more than a specified percentage? So there are certain qualitative information which needs to be disclosed as part of segment reporting, even though you concluded that this is a single segment company based on the manner in which the CODM looks. So I'm sure that we can just keep going on from a disclosures perspective. There are at least 40 standards, and these standards would have about 10 disclosures. But considering that today is an accounting standard day, I just thought that we will just throw some light on some important standards on a typical disclosure deficiency which happens, which with some proper reading and understanding and reviews when we prepare or review the financial statements, we could avoid it. Because as I said, there are many sessions which happens on the measurement 116, 115, 2, 10, 16. But I thought on this day we will concentrate on some disclosure aspects and highlight certain common pitfalls that we have noted. So that's it from me. I know that you had a very long day. So thanks for being here on Saturday and spending your time. Trust the whole day was very useful to you and you are having lots of learnings. So these are my coordinates. You can get in touch with me if you have any queries. So thanks to SIRC for providing me with this opportunity, and thanks audience for your patient hearing.
Skip our mind, though it is from 2027, it's just 1 year away. So we need to be prepared for the changes. Thank you very much for enlightening our audience. Thank you.
Thank you very much, sir.
Thank you, sir.
Get close. Okay, thank you very much and enjoy your evening, and we can see you